COVID-19, the global economy is at a standstill. Markets are in turmoil.
The S&P 500 opening lower by more than 8%. Of course, that greater than the 7% level that triggers the level 1 circuit breaker.
Retail sales down.
Oh my God, look at this. All right, retail sales year to date minus 20%.
Unemployment up.
4.4 million people filing for initial jobless claims last week.
Even if ultimately temporary, it will have a significant impact on economic activity.
Some economies are opening up.
To preserve the health of our citizens, we must also preserve the health and functioning of our economy.
Despite warnings, opening up too early could have consequences.
Ultimately, the virus is going to determine when we really can safely reopen.
In this time of crisis, how can investors navigate volatility and uncertainty? We convene the biggest names across finance, economics, and investing to help investors weather the turbulence. We are live in Hong Kong, Dubai, London, and New York for exclusive interviews and smart analysis. This is Bloomberg Invest Global.
Good afternoon. I'm John Micklethwait, Editor-in-Chief at Bloomberg. On behalf of all of us, welcome. This is the final leg of Invest Global. It's been an amazing 3 days, and we're very pleased to bring you another round of amazing speakers and insights to close out this endeavor. I'd like to start by thanking Invesco QQQ, our founding US sponsor, for helping make possible this global event. You can check out more about Invesco QQQ in the resources section of our event platform. Before we begin the platform, there is the inevitable housekeeping notes. Please make sure you're using Firefox or Chrome to view the sessions. If you're having trouble with the audio or video quality, please just refresh your browser. You can restore Windows using the buttons at the bottom of your screen, and the side of each window is adjustable. This is an interactive event, and we welcome your questions. To submit one, type it into the Q&A box below the slide window and click Submit. Please include your first name and your city when asking a question. We'll also be asking live poll questions. You'll see the questions pop up on your screen as we're talking. Please take a moment to register your responses. And please engage with us on Twitter using #BloombergInvest. To help set the stage for today's conversations, I'd like to welcome Ryan McCormack for Invesco US.
Good afternoon, and welcome to the third and final day of Bloomberg Invest, weathering market turbulence in the age of COVID-19. My name is Ryan McCormack, and I'm the Invesco QQQ ETF strategist. It's an honor to be here. I'd like to thank Bloomberg for their incredible partnership over the past 4 years. This year certainly has a new look to it, but we're thrilled to be able to continue our partnership through these unprecedented times. Over the past 2 days, you've heard from a number of the industry's brightest thought leaders, including Invesco's own Christina Hooper, discussing the path to economic recovery, and Andy Blocker, who outlined the U.S. government's response to COVID-19. Today, I'll be introducing the topic, putting money to work now, which has been a common question given the historic volatility and historic government intervention that we've seen over the past 4 months. In a few moments, you'll be hearing from Bob Prince, Co-Chief Investment Officer of Bridgewater Associates, and John Stein, CEO and founder of Betterment, for their unique perspectives on putting money to work. But before, I'd like to briefly touch on a few trends that we've been seeing. Regardless of strategy, a continued trend is the growing interest in exchange-traded funds. ETFs in the United States have taken in over $150 billion in inflows year to date. For years, the industry has heard the caution, we'll see how ETFs fare when volatility spikes. Well, over the past few months, we've seen volatility climb to levels not seen since the great financial crisis. What's more, an unprecedented number of trading professionals were forced to work from home. And even the floor of the New York Stock Exchange closed for over 2 months. Volume surged. And as an example, Invesco QQQ traded over 100 million shares in 13 out of 24 trading days, which would be the highest annual total since 2011. Despite these hurdles, ETFs largely passed with flying colors, allowing investors to access both primary and secondary liquidity while effectively tracking underlying indices. The lasting effects brought on by COVID-19 are yet to be seen. Will the U.S. population be able to recover from massive job losses and a potential sizable gross domestic product contraction? Will we see a shift in supply chain dynamics and a change in the reliance on international manufacturing of essential products? One change seems to be more immediate than others. The digitization of the workplace and economy have been accelerated, and the need for connectivity is more important now than ever. Invesco QQQ offers exposure to the NASDAQ 100 index, which includes 100 of the most innovative companies in the marketplace. This begs the question, how do you measure innovation? We believe that one way is by measuring a company's commitment to reinvesting in their businesses through spending on research and development. As you can see in the chart displayed, in 2019, NASDAQ 100 companies reinvested 10.4% of sales into R&D. Thanks to this dedication to innovation, we believe that companies in Invesco QQQ are well positioned to potentially benefit from these transformative shifts in the marketplace and economy. And we believe that their exposure to growing themes such as cloud computing, mobile payments, big data, and numerous other advances in work-from-home capabilities will likely serve them well through COVID-19 and beyond. For more on QQQ, investing with innovators, and ETF education and insights, please check out our thought leadership collateral in the Event Resources Hub. Thank you all for attending. Thanks again to Bloomberg, and we hope you enjoyed today's conversations. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Call 800-983-0903 for a prospectus containing this information. Read it carefully before investing.
Thank you very much. And with that, I'd like to introduce our first guest, David Solomon, the Chairman and CEO of Goldman Sachs. I'm not going to give him a longer introduction than that. David, welcome. Thank you very much for appearing. I'm glad we have matching shirts or somewhat close to it. I'm going to come back to talk about the virus, and I'm going to talk about diversity, where I know you've been actually a pioneer, and Goldman generally. But let's begin with the economy. And I suppose the question I had is, you look around the world, you have offices all the way around the world, as indeed do we. What sort of recovery do you see now? Earlier, there was talk from Goldman about a V-shaped recovery. What do you sort of personally expect?
Well, first, John, thank you for having me, and I'm glad to be here and spend time with you today. I appreciate the opportunity. This crisis has had a profound impact on the economic environment that we're operating in, and the result of that, obviously, was a very, very sharp, steep decline in economic activity as we led into the height of the crisis, and now we're somewhere in the middle, and we're starting to see some economic recovery. My guess is that when you look at the shape of the recovery, the initial shape of it is going to look quite like a V. We had a very, very steep decline, and we are going to have, as we open back up, somewhat of an accelerated recovery. I think the more complicated question, and a hard one really to answer at this point in time, is as you look forward, or you think about what's going to happen over the next 6 to 12 months, how are the effects of this crisis going to have a further impact on the economy going forward? And so a lot of that, I think, is still very uncertain. There's a lot of uncertainty still around the healthcare situation. There's a lot of uncertainty still around human behavior as we're opening up. And so I do think we're going to see a sharp V to start with, but it's very open-ended as to what kind of economic friction we're going to see as we get through the end of the year and into 2021. History would tell you that to fully recover from a shock like this is going to take some time. And so my expectation is, while the climb up that we see, in the initial here over the next couple of months will look quite like a V, I think it'll get more challenging and flatten out as we finish out the year and head into 2021. I think it's going to take quite a while for us to get back to where we were before this started.
I know the markets are down a bit today, but are you so? Well, they may be back up again. But are you surprised by how robust they've been? I mean, for an economy to go through this sort of shock, and with those kind of long-term productions that you're talking about, where there will be, really quite sizable effects going forward. Do you think the markets look high? Probably the wrong person to ask, but I'll try.
Well, I'm never going to say the markets look one way or another, because the markets are always smarter than I am at this current moment, at this moment in time. But what I will say, it's not surprising that there's been a flood of money into equities, given what's happened from a monetary policy perspective. The amount of monetary policy and support that's come into markets, the fact that rates are basically at zero, people that have capital deploy are looking for opportunities to earn a return, and that's pushing money into equities. I would say that, for me, the equity market does seem to be a little bit ahead of my view of the future earnings performance of businesses as we look 6 to 12 months out. And if that's true, and I'm right about that, you'll see a rebalancing of that over time. But there's no question there's been a significant movement of money into equities, which right now, if you're looking to earn a return over some period of time, is the only game in town. I'd also say that the markets are definitely telling us that people are more optimistic, here in the U.S. certainly, about the reopening. I think there's a lot of question and uncertainty just around the course of this. It's clear to me that we have to learn to live with the virus and operate with the virus and do so safely. But the markets are certainly, it seems, discounting the difficulty of that. And that's something we'll just have to watch closely in the months ahead.
I'll come back to how Goldman's reacted to the virus in a second, but just on this issue about the economy generally, you probably talked to as many sort of CEOs as anybody. Is there a sense that there is a worry about credit going forward? Is that people, there must be some companies which have really been turned upside down by this. Some of them had to go running to the government. Do you worry about that? Was that part of your worries about the sort of the slightly longer term future?
Well, sure. If you think about credit's certainly an area where any financial institution that's a significant lender is spending a lot of time thinking about what the impacts would be. At the moment, given monetary policy, which is open markets, large companies certainly have access to capital, and many of them have pulled their financing forward in a way that's allowed them to at least sit securely, knowing that they're well financed as the volatility of the crisis plays out. For smaller enterprises, smaller, medium-sized businesses, that's more complicated. For anyone that's following the banks, as the banks will report at the end of the second quarter, you'll have some clarity as to the forward when people look at the provisioning that's pulled forward in banks' income statements, especially with CECL now pulling expected future losses or modeled losses forward. So there's no question that credit's an area of sensitivity, and depending on the severity of the economic contraction and the path forward, there will be a bigger impact to credit over time. But it's still hard to judge, just as I was saying earlier, because it's really unclear how the recovery will take hold, because there's still a lot of uncertainty around the fundamental issue, which is the health issue and how it affects human behavior, how human behavior affects demand.
Do you think there's a chance of a merger wave as companies think they might be stronger together dealing with this?
Well, there's no question that the number one thing that I think affects merger activity is confidence, CEO confidence, board confidence. And so it wouldn't surprise you that as we went into the height of the crisis at the end of March and April, and this is something we'd have insight into, from our platform, merger dialogue collapsed. And there's no question that that's really driven first and foremost by confidence. I think we're now at a point where things are normalizing a little bit, and there's no question that the engagement that we're seeing from CEOs on strategic ideas, strategic possibilities has increased significantly. But as you well know, John, those aren't things that turn on a dime. Those things take time. And so I do think that we will see a slowdown in merger activity in this environment, but I do think there are a lot of very strong platforms that are going to be looking for opportunities to strengthen their position. And then there are certainly people that have interesting businesses that might be under pressure or a little weaker or might be more open to those approaches in this environment. So I'd expect a lot of dialogue, but through the summer into the fall, until there's more certainty, I still think broadly at a high level, merger activity levels are going to be more muted.
Do you see more certainty in Asia generally? I mean, you've got places like China, which have had relatively few deaths from the virus. You've got Japan, South Korea, all these countries are reopening and getting things going. I know that bits of America seem to be going a little bit in the opposite direction, and there are still worries in Europe. But is Asia going to lead the way out of this one?
Well, I think Asia is definitely leading the way out. We see it in our own business. If you look at our offices and the way we're operating across Asia, I'd say across Asia, we probably have, approximately 50% of people in office and increasing. And as I talk to my colleagues in Asia, they talk about, a cautious environment in a place like Hong Kong or in Tokyo. But at the same point, they talk about the fact that people are in restaurants, people are living their lives, people are out and about. And they talk about a much more normal operating environment there, although with caution, people obviously wearing masks, taking appropriate precautions. But the environment there is certainly a meaningful period of time ahead of where we are in Europe, and ahead certainly by an even more meaningful period of time than where we are in the US.
And can you tell us a bit about your the idea of how Goldman itself has reacted to this? You just touched on it. Do you think that the business of investment banking, which bits of Goldman do you think will be changed most long term by the virus?
Well, I don't think that I don't think the virus is going to change parts of Goldman long term in a significant way. I do think that the virus has accelerated certain trends around technology and digitization in lots of industries, and certainly financial services will play a part or will touch in that. You asked specifically about the firm and how we responded. I think it's well known. We got about 98% of our employees out of office very, very quickly around the week of the 14th or 15th of March. And we were able, because of planning we had done and work we had done, to operate, remotely, even in our significant trading businesses. And that's really worked quite effectively. And I'd say effectively at the moment, but I wouldn't say it's a long-term solution that's the best solution for us to deliver our services to our clients the way we'd like to. So certainly an environment where everybody's operating remotely, we've made that work quite effectively. But there are things that we lose out on from a collaboration perspective, and even I think an opportunity set perspective, by not having some ability to have people working together more directly in a location-based environment. And so as the crisis broke, I laid out very clearly that we were focused on three things. And I think during a crisis, you really have to think about your communication in very simple, structured ways. I talked first and foremost about how we wanted to take care of our people. We were going to take care of our people, operate a people-first philosophy to make sure people were safe. Second, we had to take care of our clients and continue to operate our business. And third, we had a responsibility to make sure we were helping in communities, because this was first and foremost a human crisis. So with that in mind and people out of office, we went on our way and we've been executing. But as things have progressed in different parts of the world, we'd like to bring people safely, cautiously, appropriately back into office. And we've been doing that, more. We're further along in Asia. We're progressing in Europe and just starting in the United States. So, as I said, in Asia, probably north of 50% and progressing. In continental Europe, probably about 25% in places like Frankfurt or Paris. In London, about 10 to 12%. Here in the U.S., we just started on Monday in New York, and we have about 5% of our people in the New York office. So it actually has been nice for me to be interacting with some people again in this building. I've been coming to work here throughout the crisis, but it's nice to start to see that interaction, and I'm energized and encouraged by it. But for us to really take care of our people and serve our clients well, we're going to be cautious, but we want a bunch of the collaboration and teamwork that comes from having people present to redevelop in some ways. And so we're focused on doing that appropriately.
Do you think that when one looks at a business like Goldman, that many people would have said that you could do things like some relationship management and stuff like that from home, but trading people really needed to be together? Do you think you've discovered how to do that remotely?
Well, we've certainly discovered how to do it remotely, but that and while we're doing it remotely and it's working, given the set of circumstances, that doesn't mean it's as optimal as to have people together. So I'll just give you, John, something that's silly. Talking to senior traders, that are operating for us, what happens in this environment is, even though senior traders can pick up things on their turrets, which we basically created for them at home, they also get direct calls on their cell phone. One of the things that happens is when you're by yourself, you don't have the team orientation that if you need to get up from the desk, God forbid you have to go to the bathroom or something like that, and you need 10 minutes, just a personal time. If you're at home and you're by yourself, you feel like if you get up or you step away, you're going to miss something because you don't have the same seamlessness in communication. And so somebody tries, they don't get you right away, they try somebody else at a different firm. And so while we make it work effectively, it's not optimal for everybody. And so there's a balance in this. I think one of the things we've learned is you can be effective, more effective than people imagined remotely if you've got the right technology and systems backing them. But that doesn't mean it's as optimal as having small clusters of people working collaboratively in the same location where you can enhance the speed of communication.
There's one thing you said earlier about people who work for you. You talked about cutting costs, and then you also talked about keeping. When the virus began, you talked about keeping employees, like most of the big banks did, or a lot of them. Has your thinking changed on that at all? Does it mean that sort of if there were to be any job cuts, you would keep those off for another year, or what? How should your employees think about that?
Well, we were very clear, as the crisis started, that at the height of the crisis, we were focused on our employees and we would not be making any layoffs. But we're running a business as we go forward, and part of our business, and we haven't done it this year because it hasn't been appropriate at the time we would normally do it, which would be the end of the first quarter. But we hire between 2,000 and 3,000 people out of school every year, and we also have a process where we always look at kind of the bottom 5% and manage out people so we can bring new, younger talent in. That's part of the way our business model works. And so as we go forward in 2021, 2022, we'll continue with that business model. We have some longer term or medium term goals that we laid out on our investor day where we think there are opportunities to run the firm more efficiently, and we're still committed to those. But obviously, the crisis changes the timeline a little bit on some of that. But right now, we're focused on operating the firm. As we go forward, though, we'll do what's right for our shareholders, and we'll do what's right to make sure that we're operating our firm as efficiently and as appropriately to serve our clients as we can.
So those issues would become closer once people are back in the office.
Yeah, I think there's a period of crisis and then there's a period of normalization. I do think one of the things that's going to be a drag on the economy broadly, and it's one of the reasons why I think, John, there's going to be a headwind. I think all businesses are learning and seeing ways where there are efficiencies. And I think that's going to have a toll and an adjustment on workforces, more broadly as we get into 2021. And that's not something that's specific to financial services. I think it's across industry broadly. Yeah. And so I do think this is something that as an economy we'll have to manage as we go forward.
Can I ask you about diversity? I looked, and you were amongst the earliest to do that. When you came in, you set these targets. I looked up 11% Black and 14% Hispanic, and you and also I think 50% women at an entry level. So you came in, and when you did that, you didn't get, I suppose, an enormous amount of credit for it. But now you're probably getting more credit. I wondered what you thought about Wall Street and diversity, and especially race. Why is Wall Street? You could well throw the question at journalists as well, but why is Wall Street not been as good on race? Why what has been the block there, and why did you seek to change that when you came in?
Well, I got John, very, very focused on diversity and inclusion at Goldman Sachs, broadly before I became the CEO of Goldman Sachs. I saw it. At first, to be honest, I first, some of it was experienced in thinking about gender diversity through my daughters who are in their 20s and their own experience, and really coming to understand how their experience as young women going out into the world professionally was different than mine might have been if I was a young man today, and really starting to understand and doing more listening and understanding of those differences. And so I got focused on this when I was running the investment banking business and really recognizing that there were opportunities to accelerate and be more purposeful and more aspirational in moving things along more quickly. And so I set goals in the banking division, and I brought that philosophy when I became CEO to try to move the organization forward. And I think it's effective. You have to set aspirational goals. You have to hold people accountable if you want a more diverse and inclusive workforce. And we've been doing that and making progress, but we still have a long way to go. And I'd be the first to say that we at Goldman Sachs have a lot more to do, and we're quite focused on it. I'd say the industry, as you highlight, has a lot more to do, but I'd say so does journalism, and so does industry broadly. And there are fundamental racial equality issues that are deeply rooted in our society. And I think it's a moment in time where leaders like myself need to spend a lot more time listening, trying to understand, and then actually taking steps that in the medium and long term will move us along more quickly and creating more opportunity and more fairness. And it's not just a question of at Goldman Sachs, it's a question of across our society more broadly. And so that's something that I believe in and something I'm going to continue to try in our own way to make a difference and contribute to. But there's a lot of work to do in improving educational opportunity and improving economic opportunity and fundamentally finding ways to make our system more fair. And by the way, when it comes to diversity and inclusion, it's a broad set of issues. Obviously, a lot of focus appropriately on the Black community at the moment, but there's still lots of issues with gender. There are lots of issues with other populations that require additional focus. And we're going to try to do things that we think make a difference. I know you're aware that back in January, we made a statement that we would not take a company public in the US or Europe without one diverse member of the board going to two diverse members of the board in 2021. I'm now seeing that that's having tangible results. You might have seen today that Palantir announced that they've added a diverse board candidate to their board. It's their first diverse board candidate, private company. I'm not sure that would have happened at this moment had we not taken a step. And I'm seeing it across private equity more broadly. Earlier, private companies are starting to bring diversity into their boards, and that's a good, important thing. And so we've got to find ways that with our platforms, we can make a difference. But it takes time, it takes commitment, and we can't let this moment pass without staying committed to trying to do more.
Do you think that in some ways Wall Street and indeed society is behind on race? It's slightly more ahead on gender. Gender was something that has Wall Street has been pushing more over the past few years. And is there anything you can learn from that at all?
Well, I do absolutely agree with you that we are behind on race. Society is behind on race, and there are deeply rooted inequalities that exist that come from long-term policies and an awful lot of history that we're going to need to work very purposefully as a society, as a community, to start to reverse, unwind, change, and it's going to take quite some time. I think what I've learned for Goldman Sachs, speaking narrowly for Goldman Sachs, having purposeful goals, creating metrics, creating accountability, shining a light on that, and holding people accountable makes a difference. And while it's slower than we'd like it to be, I don't know any other way to advance the ball other than to be very purposeful, thoughtful, and metriced in your approach. And so that's something we're trying to do. And that's something we've seen in some of the gender work we're doing. But we've been trying for a number of years to apply it more broadly. And while the progress is slow, we are making progress, but a lot more work to do.
I just looked on the internet this morning and I saw that Jamie Dimon had taken the knee and it had been a sort of symbolic gesture. Would you do the same thing?
Well, I saw the picture of Jamie. I don't know what the context was, but somebody put the picture in front of me. But I stand with the Black community at Goldman Sachs and with the Black community more broadly to try to do my small part to listen, to become better educated, to better understand, and given I'm in a position of influence, to try to make a difference to move things forward. And so, my support is going to come from doing what I can do to help advance here. And that starts by trying to have difficult conversations, by doing a lot of listening and trying to learn to become better educated, because I'm not in those shoes. I don't have the experience of a Black colleague at Goldman Sachs or someone who's Black in our society. And I need to learn more, listen more, and try to see how I can use my platform to help advance those issues.
Can I ask you a bit about the Goldman business, just to finish on? You made a big push into consumer banking, and I saw in the first quarter you made $282 million in revenue from that, which is still only 3% of overall revenue. Do you have a kind of goal for when you might reach, say, 10%? What is it? What's a reasonable standard for somebody like me to come back and ask you in a kind of couple of years' time, have you reached this level?
Well, I think what you can look at, John, if you're interested in understanding the vision we laid out for our consumer business over the next 3 to 5 years, is you can look at our Investor Day presentations, and we laid out a vision to grow the business, broadly and build an all digital consumer banking business that took the friction out of financial services for consumers. It's really, really interesting. This is an innovative business platform inside Goldman Sachs that now has over 5 million customers. It has over $70 billion of digital deposits. We've started a credit card that by any standard is the fastest growing new credit card ever. That's a critical mass. It's getting very, very strong reviews from customers on a relative basis to other credit card product in terms of how the product performs and the digital interface. We're building a nice business. If you plop this business, off somewhere else, it would be quite valuable. Inside Goldman Sachs, I think at the moment it's a show me. So we're very committed to it. We think we're going to build a big business over the next decade. I think over the next 3 to 5 years, you'll see a clear impact of the direction that we think we can take this.
We've just got a question from the audience saying that you've made some moves into wealth management. Is that something which you want to grow in the same way as the big Swiss banks and various people have really been pushing? Is that something that you see as a big part of Goldman's business going forward?
Well, we have a very big wealth management business. It's a very sizable business inside Goldman Sachs right now, and that wealth management business really has been centered around what I'll call an ultra high net worth wealth management business. And we've started getting into just high net worth wealth management through our ACO platform, which really allows us access to wealth management customers through the corporations that they're involved in, because we provide counseling services, financial planning services to employees in those corporations. We've got a pretty big platform. We have a large asset management business, especially with digitization. It just seemed that there's no reason why we can't have a broader access to the wealth management wallet that's out there, given the infrastructure that we have. And I think one of the things that many of your listeners would understand is the wealth management business is extremely fragmented. We have a very strong position in ultra high net worth wealth management, but in high net worth and also in mass affluent, we think with our brand, with appropriate digital applications, we're in a position where even small share can significantly help us grow that business. So we made an acquisition that expanded the high net worth wealth management business, United Capital last year. It gives us a broader footprint to expand in that. We're going to continue to look for opportunities to expand the already significant business we have in wealth management.
Do you see any change in the competitive lineup? I was just thinking this morning when I was reading about Goldman, you look at the names which are competing against you. They tend to be, I was about to say irredeemably American, but they're certainly American. You've got JP Morgan, you've got Morgan Stanley. But, 10 years ago, if we talked then, people would have talked about Deutsche and some of the Europeans. And maybe sometime in the future, people are going to talk about companies from Asia. But where do you see the threat coming from if you put the Americans to one side?
Well, it's interesting, that you asked that question right after asking about UBS and Credit Suisse and the wealth management business. Yes. So, it depends on the business that you're competing in. And, certainly in the asset management business, we compete with firms, from all over the world. In the wealth management business, we compete with firms all over the world. In the, core, what I'll call corporate investment banking business, there's no question that for a variety of reasons coming out of the financial crisis and the resorting, the 5 or 6 large U.S. institutions that compete globally in corporate and investment banking have a much stronger global footprint than many of the European or Asian competitors. I think that there's always competition in any individual situation from competitors all around the world, but the market share and the scope of the footprints, if you look at the top 3 competitors in those businesses at the moment, happen to be U.S. firms. I think it's getting increasingly hard for people that don't have the scale and the global footprints and the access to technology resources to play catch up, but that doesn't mean that they can't have strong regional businesses or at some point in time, compete more broadly globally. But we have lots of competitors in any given situation. There are lots of competitors that compete for that business, and we know we have to show up with great people, great client service, real focus on our clients every day if we want to continue to have strong shares and win in those businesses. And the competition can come from all sides.
Coming to see your predecessor many times, and we would discuss how the world was moving towards a kind of much
John,
more kind of global financial world. Now it's getting much harder.
John, I'm sorry, you broke up for a second. Could you just repeat that?
I was asking whether whether financial globalization, which has driven so much of markets, the idea that Goldman could operate all the way around the world fairly seamlessly, whether that is now under threat. You've got differences between America and China. You've got various barriers going up.
Well, I think there's no question that nationalism's on the rise. There are global tensions, particularly, the U.S.-China relationship, but also China's relationship with the developed world more broadly, that are making the world a little bit more complicated to navigate if you're operating globally. That said, some of our businesses are truly global, and I think we'll continue to operate. Some of our businesses are more regionalized. You talked about our consumer business. While we do have a consumer business in the UK, our primary focus is in the US, and I think you would observe that when you look at consumer banking businesses around the world, they're much more regionalized than they are global. So I think there are some businesses broadly that are regionalized, some that are global. I do think that there's a risk of more nationalism, more tension, more friction around the activities of an organization like Goldman Sachs globally, but I don't think it threatens our ability to operate globally. I don't see that in the near term, but I do see more friction. And I do think the relationship between the US and China, the relationship between the EU and China, these relationships will be extremely important and an extremely high point of focus for all of us that are operating in markets over the next decade. And depending on how those relationships evolve, they can be a tailwind to growth or a headwind to growth and activity. And I'm cautious. I think it's going to be a bumpy ride. Having nothing to do with COVID, I would have made that comment, before COVID, and COVID obviously is an amplifier.
Do you see the Chinese still being committed to opening up their markets? I remember, I think the first time I met you was at a conference in Beijing, and you sat and saw this pull then that the Chinese seem to be keen to keep on bringing in more of the West, perhaps not giving you as much access as you wanted. But do you think that's still happening?
Well, I think they're moving. I think you have to watch it. I think some of the stuff with respect to financial services is really linked to stage one of the trade deal. And I think it's moving forward, but the relationship is fragile. And, I could see ebbs and flows, but I believe in the long run, there are a lot of reasons why that opening up of financial markets is good, not only for U.S. firms and global firms, but I think it's also good for China. And I think China understands that. And so in navigating the macro political relationship, I still think they're inclined to continue forward in that direction, but we'll have to watch that closely.
Don't you feel somewhat frustrated? I was trying to remember back in my youth, obviously, people from Goldman would come around and try and persuade me that why China should be part of the World Trade Organization. Goldman was one of the great proponents of that. And yet you still haven't got as many licenses as you might want. China does seem to run finance on its own terms.
Well, they certainly have up to this point, and it's not been fair or balanced. And, I think one of the things that's very appropriate in the context of what both Democrats and Republicans in Washington have really turned on to is we have to rebalance that relationship, and we have to make sure that things are more fair and equitable than they've been. We had a foreign policy strategy that went back, to the late 1970s, and we're adjusting it now, and I think that's appropriate.
I can leave the last question to one of our audience members who says, how do you view the structure of the markets now that the government is effectively backstopping credit? Does that change the way you view your fixed income platform making money for the next 12 months?
How do I view the structure of markets? Well, there's no question that the monetary policy is having a profound impact on markets. It has, at a moment when it's been, I think, important and appropriate, the Fed has appropriately provided liquidity or a backstop for liquidity that has opened up capital markets so that businesses can access credit. And I think at the moment that's been important. The trajectory of that and how that evolves and how that monetary policy continues to support and what ultimately happens to the economy, that's where we started the conversation, I think is still relatively uncertain. There's no question that a business like ours, our trading business, benefited from higher client activity as the crisis unfolded because clients were repositioning portfolios and they needed access to liquidity. There's no question that as companies have pulled forward capital raising, we've pulled forward capital raising activity for companies that we might have seen a few quarters out has been pushed into the first and second quarter this year. So, we've seen short-term benefit. I think the more interesting question is trying to guess as to how this will navigate and play out over the next 6 to 12 months. And that's harder to say because there's still a lot of uncertainty.
In the end, last night I interviewed Manny Roman and from PIMCO, and we are living in an age of, there's a nice essay in Foreign Affairs about being an age of magical money, where the Fed, where the ECB, all these people are printing vast amounts of money, or certainly providing huge amounts of liquidity. At some point, we have to unwind that, surely.
Surely, and there'll be consequence to that. I think at the moment, given the crisis, I think the Fed, Treasury, the EU, people are responding responsibly to try to support the system at a time that people are very, very effective. This is what government is supposed to do at the time of a universal crisis like this. They're supposed to step in and provide support. But there is consequence to the support. The support is not unlimited. And you can look back at how long it took us to unwind some of what happened during the financial crisis, and that had an impact on muting growth. And so there will be consequence to this, and we'll have to find a way to work through it. I don't think answering that question today is something that we should be primarily focused on. We should be primarily focused on navigating our way through the crisis, but then we will have to focus on the consequences of these actions and the consequences of the hand we were dealt as we move forward.
So from a fixed income point of view, perhaps the sort of starting point is don't bet against the Fed for the moment, but at some point there has to be things like credit and all those things have to come into the picture.
Absolutely. But as you said earlier, with the market, don't bet against the Fed. I think monetary policy around the world is having a big impact on markets. And so, we'll watch how that unfolds. But in the short term, it certainly had a meaningful impact on markets.
It seems very appropriate to end with the markets. But David Solomon, thank you very much for talking to us. That was a wonderful way to begin. I'm going to hand over to my colleague, I think it's John Ferro, who's coming in to take over, or it could be Scarlett Fu. I will hand over to them. But once again, thank you very, very much to David Solomon of Goldman Sachs.
Thank you very much. And I think we'll pick up on that magical money point and take it from there. We are operating in a world of radical uncertainty. And I think market participants have been comforted by extreme policy support, which I think has left us uncomfortably detached from the world around us. And a man to put it in perspective, I'm really pleased to say, joins us right now. It's Bob Prince, the co-CIO of Bridgewater. Bob, fantastic to have you with us at this conference, sir. Thank you. 6 months ago, and I think 6 months ago feels like an absolute lifetime for you and me, but we were in the mountains of Davos, Switzerland. And as you know, the people that attend that conference are often detached from the world around us. You said something to me that just woke me up and everyone else listening. You said, the boom and bust cycle, as we know it, is over. A couple of months later, I just wonder how you reflected on those comments and whether the policy response really summarized what you were getting at. What are your thoughts on that, Bob? The policy regime we're in right now.
Well, we've certainly transitioned to a new monetary policy regime. And the nature of this cycle is radically different. Even without it, I think we would have been in a different kind of a monetary and business cycle regime. I think the unfortunate thing is at the time, I don't think any of us were talking about the virus. But, when I just to focus in on kind of where we are now and how that monetary policy cycle fits in, I think there are really three key elements to the current set of circumstances. We have a collapse in global income caused by a pandemic with interest rates at zero. And pretty much everything follows from that. This is very much different than a typical economic cycle, because a typical economic cycle is a contraction in credit brought about by a tightening of monetary policy or fiscal policy, which is largely under the control of the central bank. And when things get bad enough, they cut interest rates, they ease monetary policy, and you come back out of it with an expansion of credit. What's happening this time is that we have the collapse in income. The causal influence is the virus. It's the pandemic, and it's the fear of safety. It's basically people staying home and not producing things that's caused a collapse in income, and the collapse in income causes a collapse in spending. So whereas normally you have monetary policy leading that tightening, credit falling, spending falling, and then income being the last thing to fall, in this case, income is the first thing to fall, which is causing a reduction in spending and then all the reactions to that. The driving influence is the virus, which nobody really understands very well, let alone the government responses to the virus, and then the responses of the public to the governments, and very big differences across countries. So there's a huge amount of uncertainty related to the virus as a causal influence. And then to pull out of this, you have zero interest rates. You're also going into this accumulating credit as opposed to reducing credit. So normally in an economic contraction, you're reducing credit, raising interest rates, which gives you a lot of room to cut interest rates and expand credit coming out. In this case, we have zero interest rates, you can't cut them, and credit is expanding, which reduces the potential to pull out of it. So the solution to that problem is actually appropriate, and it's what we refer to as monetary policy 3 or MP3. Monetary policy 1 is really an interest rate driven monetary policy. That's pretty much come to an end when you hit zero. Monetary policy 2 was the QE driven monetary policy post 2008, where you just buy the assets. But when the risk premiums are already low, there's a lot less potential for that. Monetary policy 3 is where we are now. And MP3 is the coordination of fiscal policy with monetary policy, where really the biggest actor is the fiscal stimulation, where you can direct the funds to the parts of the economy that most need it, but you support that with monetary policy and the printing of money to buy those bonds so that the interest rates don't go up and reverse the effects that you're trying to achieve. So that's a direct reflection of the fact that we're at zero interest rates, income and income levels are depressed. The actions to date are roughly appropriate. In other words, the amount of printing and the amount of fiscal stimulation has been roughly sufficient to fill the hole in incomes that was created. But not all of that money is getting spent. Let's say 50 cents on the dollar that the government is sending out is actually getting spent. And so actually you haven't had nearly as much of a improvement in spending in the economy as you've had in the liquidity in the system. In addition, the central bank is printing money over and above what it takes to finance those deficits and sending that into all kinds of assets. And so we have a major reflation going on, which has been by and large successful so far. The big question about that is that while we're used to thinking in terms of growth rates, which is changes in output over short periods of time, the big thing that's happening now to be thinking about is the collapse in income and the level of income that exists. Because the low level of income that exists will be with us for a while in some substantial degree, which means lower profits, lower spending, and so forth. What also means lower cash flow. And for those that are in, kind of treading on thin ice with respect to their financial position, the longer that this goes on, the more difficult it becomes for them. And so you have these two pressures really operating at the same time. You have the collapse in income, which is collapsing cash flows, which will affect those that are most vulnerable to the collapse in cash flows. And you have the expansion of liquidity by the central bank going into assets, but may not be sufficient to cover those cash flows. And the programs to date are by and large sufficient to cover the income gap for about 3 or 4 months, starting from April. So we're really talking about an amount of money that gets you through the summer. And the problem then is that we're talking about the virus, which has a time frame of probably 18 to 24 months. And so I refer to that as a duration mismatch, essentially the time frame of the virus impact on spending and income in relation to the time frame of how long people can last financially.
So as you pointed out, we've got a duration mismatch. Though, as you can see, up until today, with markets down aggressively, we've had a huge rebound because markets are focused on the liquidity side of the equation, not on the cash flows. Are you saying, Bob, are you anticipating that in the next 3 months, as this Band-Aid that was put on a couple of months ago starts to wear off, that we could hit another air pocket?
Well, you're just going to see an instant replay. Over, every 3 or 4 months, you'll get the instant replay until governments run out of either the willingness or the ability to cover that gap. And so that becomes a very large uncertainty. And that's also different country by country. The United States is in the best position as a reserve currency, but your typical, emerging economy can't necessarily go to the well over and over and over again. And so that also produces differentiation. So the divergent pressures between the income and cash flow to individuals, companies, and even countries, and the production of liquidity is a force that will create a lot of differentiation in outcomes. Your long duration assets, your storeholds of wealth benefit from the liquidity. But if you're a restaurant that can't get the next loan, right? Or maybe you don't want the next loan, that liquidity may not help you. And so those companies and those individuals and those countries, which are most exposed to the cash flow impact, they're not storeholds of wealth. They don't get the liquidity. They suffer the most. And so that creates a differentiation of outcomes over time, which will be a really key element of what transpires in the next year or two. And from our standpoint, requires two things. A, it requires diversification. You don't want to be on the wrong side of that. And B, it presents alpha opportunities. If you can identify how those differential forces will play out.
Well, let's talk about the divergence right now and define what the wrong side of things actually is. Do you think the market's doing a decent job of discriminating and looking through the things that you identify?
Probably not good enough. I mean, you do see some differentiation, but if it's like 6-4, but the ultimate outcomes are like 8-2 or 10-0, then no, they're not. And so this is a very unique set of circumstances from a market standpoint, because normally we're all thinking about sort of, is the next move up, is the next move down, and that sort of thing. We're thinking in terms of growth rates. But, if you start from a 20% unemployment rate effectively, and you get a lot of growth and you go to a 15% unemployment rate, that's still a 15% unemployment rate. That's a massive shortage of income that's embedded in the system that you either have to allow to flow through the system or the government has to fill that hole. If you go back to the financial crisis in 2008, the peak unemployment rate was 10%. So if we bounce back from a 20 to a 10, we're just where we were in 2008. And then we're there without the ability to cut interest rates and move forward, and having built up a lot of debts just to cover the income hole that we were in. So I think that the difference in the market, the way the markets will play out versus normal, is this accumulation of a low level of income over a long period of time, which is a much different sort of grinding influence that almost can't be really discounted ahead of time effectively, because you really don't know how long it's going to last. But the longer it lasts, that grinding effect of a lower level of income over a sustained period of time will gradually manifest itself on some parts of the economy in the world, while at the same time, the efforts to offset that with liquidity will benefit other parts of particularly the marketplace and to some extent the economy. I'll add one other thing to this, which is that at the end of the day, governments normally get what they want when they try hard enough. So we've gone back to 1800 and studied every financial panic and resulting deleverage or reflation. And in something like 115 out of 125 times across 39 countries, governments got what they wanted. But those getting what they wanted required choices. So, for example, you got four big ways to kind of untangle yourself from a mess. You've got an easy to monetary policy. You've got an easy to fiscal policy. You've got a debt restructuring, and you've got a currency devaluation. And so right now we have the first two. We have the easing of monetary policy and we have the fiscal policy. And it's an all-out effort on that basis. The question becomes, at what point is that enough Or do we then transition to debt restructurings and currency devaluations? And from there, what is the status of the dollar as a reserve currency? And then from there, what is the storehold of wealth? And those are the big questions that we're really focused on right now. And also our clients are really thinking a lot about as well.
Bob, these are huge, huge issues. And for everyone tuning in right now, I think they want you to lift the lid on Bridgewater. What are you positioning for? With everything you've just said, all the risks surrounding that, what are you actually positioning for?
Well, I can't go into specific positions, of course, but the I think there are really three big. We've got our normal processes, assessing relative value and so on and so forth, and that's spread across a lot of different markets and very diversified in our positioning. But there are these three big forces will be relevant to probably everybody's positioning, but reflation, storehold of wealth, and differentiation. Those three themes are a good basis for thinking about how to structure a portfolio, whether it's for a strategic asset mix and a diversified asset mix that you hold, or whether it's for a sort of active tactical sort of trading. Reflation, what's a storehold of wealth, and differentiation of outcomes.
Can we talk about what a storehold of wealth is? I remember in January, Ray Dalio, your colleague, partner, and I'm sure good friend as well, made some headlines when he said cash is trash. Given where rates are right now, cash is looking pretty good. What is a storehold of wealth right now, Bob?
Sorry to interrupt you. I said he still says that.
Does he?
So almost every day. But so people typically think about cash as the risk-free asset. But when you're in a reflation, you can have a negative real return of cash, and it's not a good storehold of wealth. And so the types of things that you want to look to as a storehold of wealth are things that retain their value in real terms in such circumstances. And so, for example, we talked about gold. Obviously, gold is just a contra-current. It's really a currency. If you take the forward price of gold, it's just gold per dollar, ounces per dollar, or dollars per ounce. And so gold is one of those because the utility value of gold is higher, but it's because fiat money declines in value as you produce it. And so gold prices go up. It's mostly that the value of money is going down. And so the gold price is a metric for the value of money, mostly. But also you have other sources of storeholds of value. Let's say inflation index bonds are really a useful storehold of value because you get paid the inflation rate, right? We look at things like, certain types of equities. It's very interesting that, so long as the capitalist system is in place and we have, free markets and economy and companies that operate as the distribution of resources, you have companies participating in the economy, and certain types of companies have cash flow that actually establishes them as a form of a storehold of wealth. So, for example, if you're own a chain of movie theaters, that's not really a storehold of wealth because people don't have to go to a movie. But if you're talking about food, water, and basic healthcare, these things are necessary to physically live. They're physically necessary all around the world, everywhere. And so there are certain types of spending like that you can be assured that in 1, 5, 10, 20 years from now, people will buy food, they'll buy bread, they'll buy water, and they'll buy, aspirin or whatever. And then the companies that provide that are in effect a form of a storehold of wealth. If you have certain kinds of technology companies that are at the sort of the vanguard of productivity, and they're the sources of productivity, sort of the fountain of innovation and productivity and economy, the duration of their cash flows will be much longer than a company that's got a very short duration of cash flows, and they'll be much more benefited by the liquidity production than the other types of companies that'll be hurt by the contraction in incomes. So, these are the types of things that we look at as thinking about how do you think about a storehold of wealth over time.
Something I wanted to finish on, which I think is a really important theme for a lot of people right now. You mentioned free markets and capitalism. This doesn't feel like capitalism. I don't think we can pretend this is capitalism. The Federal Reserve seems to have lost faith in the capitalist system. I've asked President Bullard about this earlier this week. I'm just wondering from your perspective how things have changed now, from a market participant's perspective as well, where you can make the right macro call and then get the market call really, really wrong because you get slapped around the face by a policymaker that just has other ideas about what the price of something should be. How do you participate in a market quite like that one?
Well, just like we talked about at the end of the boom bust cycle, as you know it, because of the nature of the dynamics has changed, that has progressed to what you're talking about, which is MP3 puts the government in the middle of the distribution of capital, right? So capitalism, as we know it, is the government steps back. Those who have savings or capital make decisions about where to send it on the basis of risk and return. And those who need it try to provide a good deal for that. And then that provides for the distribution of resources. But that hasn't solved that's led to certain problems. Number one, it's led to over leveraging, too much debt. It's led to income and wealth inequality, which is producing political conflict and so forth. So it's not solving all problems. It's a good system, but we're now in a difficult set of circumstances. And so now enter the government, where the government is now involved in making choices about where capital goes. And we can call it state capitalism. It's not like capitalism doesn't exist, but state capitalism, where there's a certain degree of directed capital. And I think, and an element of this is the too big to fail has broadened. It used to be that there was no such thing as too big to fail. We let Continental Bank just go down, right? There was no such thing as too big to fail. Then we realized, hold on a second, certain banks are too big to fail. Now we're at the point that certain companies are too big to fail. And so now the government is making choices about what's too big to fail, but they're doing it because they're making a choice pertaining to the populace. In other words, income inequality, people need jobs, you need to support your population. And so they're making very practical evolution in capitalism to achieve what are their greater goals. Their greater goal is not that we have capitalism. Their greater goal is to have a healthy, quality public. And if you don't have a healthy, quality public where people have food and so forth, as a government, you'd better find a way to do that. Otherwise, you're going to be held accountable in one form or another. And so this transition to state capitalism is a practical response to that. It doesn't come without costs. And in David Solomon's interview just before this, they were talking about that a little bit. And it doesn't come without costs, but what it does is it comes with choices. Because like I said, let's say you have a debt restructuring. Well, the person who held that debt is not coming out very well on that, right? But maybe the greater good is achieved according to the government. Or maybe you have a currency devaluation. Well, if you're holding that currency, you're not served by that. But maybe the greater good is served by that according to somebody's judgment. So who is making the judgment is shifting to the government, because the government is ultimately accountable to the people, not to the investors. And so the investors, it's our job to just figure out what's going on there and stay safe and stay positioned for it. But I think in that world, you asked me, how do you deal with that from an investment standpoint? Yeah. You have to be able to track where the money goes. The world where you just cut interest rates and now sort of figure out what the interest sensitive parts of the economy are, that world is gone. Now it's like, where's the money coming from and where's it going? How much is staying in the country? How much of it is leaving the country? What kind of companies is it going into? What kind of companies is it missing? And so on and so forth. And so you have to be able to track the money in order to have a chance to understand the markets and the differentiations and that are going to be occurring.
And Bob, I think what makes everyone uncomfortable is the government making a lot of those decisions for us. Bob, it's a conversation you and I have got to continue another time. Bob Prince, really appreciate your time at this conference. For Bloomberg Invest, Bob Prince there, the co-CIO of Bridgewater. I want to hand over to my colleague and good friend now, a conversation you don't want to miss, Bloomberg's Sonali Basak. Hey, Sonali.
Thank you so much. Great conversation there with Bob Prince of Bridgewater. I want to bring you a new guest, Jane Fraser, who is the newly named Citigroup president. She was just named late last year. Before we bring her over, we do have a question from a poll for the audience, and it's about the second wave of the COVID-19 crisis, obviously something that's sending down the market today. The questions are whether, yes, people think there will be a deadly second wave and result in further lockdowns, no, that infections will steadily decline, or a third option is that the virus will remain, but it will be prevented from having a second wave. And we have the answers coming in now. By the way, Jane is a very good person to start this question with, given she led the COVID response at Citigroup in North America. It looks like a lot of people really are expecting a second wave that could be very deadly here. About half the audience believe so, and some believe that it's about half now believe that the second wave will be prevented. Jane, how are you viewing this issue as we work further into the year?
Well, I think we're being very focused on data as we're looking at it and what is the health data telling us. And we've seen very different stories in different parts of the world. In the States, in many parts of the States, the first wave isn't over. And we're still waiting to see whether we can bring that curve, not just bend it, but bring it right down. And those are things around community spreading and around hospitalization rates and around the percentage of tests that are positive. So I think it's too soon to know where it's going to be, and the doctors are probably the best people placed to tell us.
That uncertainty that you're seeing, obviously you have a lot of planning to do for a lot of people in a lot of different types of business lines, right? Citi has a lot of folks that they have to consider that are not the traders that also have to be coming back into the office at some point. You know, we have UBS that said a third of their workplace can permanently work from home, and JP Morgan saying as much as 20% can be back in by Labor Day. Where are you on that spectrum?
Well, I do believe that how we work has really changed pretty irrevocably. However, I'm not prepared to declare the death and demise of the office yet. And so when we're looking at the future, we do expect people to work more flexibly. We've proven to everybody's surprise that it is quite easy to work from home. In many jobs, we never imagined that you would be able to before. And now what we're looking at is, we have to wait and see what happens. The health data, I think, will determine what percentage of us is back in different parts of the country in the future. And in the long run, I think it's very important that we're back in the office. There's a belonging that's very, very important there. We see it in terms of the culture, particularly in banking. There is a daily fix of collegiality that is somewhat missing on the Zoom calls. There's the apprenticeship that you get, the feedback as you walk out of a meeting from someone more senior. Watching others in action and then getting that coaching and many different intangibles from being in the office, particularly new recruits coming in and joining an institution. So I think being back is going to be important, but the paramount piece is going to be we've got to keep all of our people safe. And so that's going to be the priority.
Jane, how does this change for different jobs? You mentioned the bankers needing to be back in the office sooner to be able to interact with each other. But are there jobs that just don't need to be back right away?
I think none of the jobs need to be back right away. Beyond those, there are a few that are in the office in the industry at the moment. But as you know, we were hearing some of David and others talking about earlier, even trading, which we never imagined could be done so successfully from a remote model, has been pretty effective. So I think it's going to be a question of until people feel comfortable that they will largely decide from themselves whether they want to stay at home, how they feel about a commute, what's going to happen with childcare, as to whether people are going to be able to come back or not. And then in the long run, some jobs will certainly be most likely to be done from home, or that flexibility being provided, and others generally preferable to have in the office from an infrastructure and other perspective.
So I really want to jump also now to the consumer, because that is something that you oversee, and it's something that perhaps you have more experience with than anybody on our entire conference. There is a big question mark about demand side destruction and how much that can create a hole in the economy moving forward. How much are you worried about this?
I am worried about it. I think there is a veritable alphabet soup of scenarios out there for where the economy heads next. So it's, the root cause has been a health crisis. We don't know where that's going to go, and therefore what are the ramifications for whether it's a partial V recovery, where there's a W because there's additional lockdowns, and the impact that's going to have. What we are seeing is in this first act of COVID, there has been incredible success from a lot of the government programs, and that has helped the consumer. I think when you look at the small business program that was put in place, 80% of employment in the US is small businesses and medium-sized enterprises. So the support into that group of employers has been very, very fundamental in helping maintain payrolls. The support into unemployment benefits also being critical. So we've been surprised, while we had about 2 million or so customers who have signed up for relief programs in the States, a very large number of them carried on making payments. And we've seen the re-enrollment rate into these programs down in the single digit as a percentage of the previous enrollees. So this first phase has worked well, but the future at the moment is anyone's guess, and you've got to think scenarios.
So we saw a very significant government stimulus in the first part of this crisis. $1,200 checks given to Americans. But do you think that once some of the stimulus starts to wear off this first round, that we'll see a rise in defaults from the consumer?
Yeah, I think it is a distinct possibility. I know we've seen a number of people come out of relief programs and then go back to paying credit cards, for example, in full. And I think the big question will be how much of this is because it's from the stimulus programs, and how much of it is people going back to work again, which I know all of them want to. So at the moment, it's looking optimistic. But really, the health situation is going to drive what really happens, and whether it's this W or how strong the V ends up being. And Asia's been a little concerning. Asia has been very sluggish in the return of the economy in many of the sectors. The consumer has been more cautious about spending. And even though the health impact there has not been as great, the consumer is far from firing on all cylinders in Asia, and I think that's a point of concern for us here in America.
Now, given in our conversations, the consumer is becoming such a big part of what economic growth rates could look like moving forward, can you hone in a little on what your biggest concerns are? Where are the areas where we may see the most pain points moving forward?
Well, if you look at from the consumer perspective, first of all, unfortunately, who got hit hardest? The youth, minorities, low income, because many of the individuals who were able to work from remotely and from home tended to be in the higher paying roles. So the immediate hit was to some of the more vulnerable parts of the population anyway. The health crisis hit the elderly, whereas the economic impact tended to really hammer at the youth and the minorities, as we know. So that I think is a point of real concern for us to think about. How do we help them recover? The other question that comes up that we're going to have to, we'll find out before too long, which of the different corporate sector will need to restructure because the demand just doesn't recover and that we don't need the capacity we have. And what does that mean in terms of a round of corporate layoffs in the sectors that have been hit the hardest by this, or that may be hit by a longer term macro slowdown. So there are some additional acts of this play to come. And I'm hoping there's only two of them, and it's the second one's very positive, but it could be several.
So, given that minorities did feel such a brunt of the pain in this crisis, I do also want to talk about the protests and diversity initiatives more largely. We all know that Wall Street has faced kind of troubles with diversity for a long time here. An interesting statistic my colleagues have reported out is that out of 80 executives listed on the teams of the 6 largest banks, there was only one Black executive, and that's Mark Mason of Citigroup.
Yes. My friend.
Yeah, exactly. So why do you think Wall Street so largely has failed at their diversity initiatives over the last couple of decades?
One can point to a host of different pieces. I think what is more relevant is how do we actually use this opportunity to set a vision for better and to think about what is it we need to do differently going forward rather than dwell too much in the past as to what are different issues. I think we need to understand what the different concerns of our Black community in particular are, and our other minority colleagues. But the piece is, what is a vision for better in the future? What is it that needs to change? What do we need to do radically different? So we need to break old norms for sure. We need to break some old stereotypes. We need to get rid of bias. But the main thing is we need to build a better and more equitable path going forward. Some of these things, numbers matter. Right? On my scorecard, I have metrics for the percentage of Black colleagues that I bring into the bank. I have metrics around the percentage of women that we have in representation goals. And we've made that very transparent within Citi. We have we call it the ugly truth. Women are paid 73% the median of what men are because we just don't have enough women in the higher paying and the more senior roles. That is even more true in our Black population. And it's true in different parts of the world with different populations. But I think the piece now is to begin moving away from the ills of the past and behaviors of the past and start converging on a positive vision for the future that I think we've got a real shot to make material change in. And some of that will be also providing support, not just in our own shops, but also what are we doing in affordable housing, in low-income communities? What are we doing to work with activists? What are we doing to increase the credit aperture? So we've all got to act in society, not just in our own four walls.
That's a great point, Jane. And I want to get your opinion here. The banking industry, I think people are going to look around and say, how is it that underrepresented communities are so have such low banking penetration rates right now? Yeah. Citi operates in such big cities, and you had mentioned something to me before about different ways of underwriting credit so that banks like Citigroup can be addressing those communities. Can you speak to us a little about those ideas?
Absolutely. I think because we operate in so many different geographies, we've got the benefit of seeing where Asia, frankly, has been much more successful in driving inclusive finance. And we've seen many markets there where there is really not good data on which to make credit decisions for lower income communities. And so, the use of machine learning and data to bring data from all sorts of different sources to replace the FICO score, as it were, and open up the credit aperture, open up access to credit. And you marry machine learning with also different digital channels. So the QR code type systems, free instant payment systems that we've got in countries like Mexico, India, China, obviously the leader there. Those are all enormous opportunities for us to use this supercharge to digital for good beyond just a lower and more seamless customer experience. Let's drive it to help address some of the inequalities and lack of access in the markets. And I think that's an important role for the banks to play. Use that innovation so that we bring everyone along with us and don't leave people behind this time.
So I have time for one more question for you, and I want to ask something that involves Citi's global reach here, because given we're seeing so much tension arise between China and the U.S., given that the COVID crisis has really shined a light here on supply chains and the globalization of the companies in the world, how is that going to change? How are supply chains going to fundamentally change business as we know it today?
So I think what's happened is COVID-19 has accelerated some of the changes that we already started seeing from our clients and how they were thinking about their supply chains during the China and US trade tensions and disputes that were going on. And you've seen typically supply chains used to be linear, and now our clients are moving to far more resilient, far more diverse supply chains, not dependent on one individual supplier. We're also seeing more nearshoring or onshoring, so you don't have issues with some of the breakages we've seen, from COVID. We're seeing more regionalization of supply chains, so US north-south, US down to LATAM, Mexico in particular, replacing some of the east-west chains that we'd seen before. So more of this regionalization going on. Ironically, everyone says globalization is dead, but I have to say in the trade side, our trade origination has been up 40% year to date. So the clients are very busy innovating and making structural changes, and COVID certainly accelerated that. And again, not sure whether it's better or worse, it's just different.
Jane, thank you so much for your time today. That was a great interview, and we hope to check back into you as this period of time progresses. I want to now toss the conversation over to my colleague, Annie Massa, who will introduce us to our next guest. Thank you so much.
Thank you.
Thank you so much, Sonali. I'm Annie Massa, and I have with me here today Chandran Thomas, President of Northern Trust Asset Management, to talk about the future of the asset management industry. Welcome, Chandran. Now,
Annie, how are you doing today?
Thanks. One thing really that struck me moving into this year is how competitive the fund management industry has become. And in some ways, the COVID-19 crisis has sped up some trends that were already underway. What do you see as some of the most important forces shaping asset management right now?
So there are a couple of trends, Annie, when I think about the industry that are really impacting it. So from secular trends, I would start with just thinking about the meager organic growth that we see. And this is not something that's new. If you look over the last 10 years, last year was an exception in terms of flows, but we've averaged somewhere in the neighborhood of between 1% to 2% organic growth. And that's a very different dynamic than what we would have seen in the decades preceding that. And that's largely driven by demographic trends. The next thing I would offer is the persistent fee pressure. And people talk about fees, but one of the big things there, it's not so much just lower pricing. In fact, the major pressure that we're seeing from a fee standpoint is people actually shifting to, say, index and or other lower cost products, and that's important. Rising structural costs, if you look at what we have to do from a technology standpoint, compliance, innovation, those are secular trends that are affecting it. But there are some that are also beneficial depending on how you play them as a provider. The consolidation of both buyers and sellers that we're seeing in the market, the shift to what I call outcome-oriented solutions, investors willing to give up discretion in things like multi-asset solutions. And finally, probably one of the more important ones over the next 5 to 10 years, the digital innovation that we see shaping the future. And so when you think about the pandemic, it's effectively accelerated the pace of all of these secular trends. And so I think it puts us at an even more pivotal point in the industry.
Sure. Could you drill into a little bit? You mentioned fee pressure, technology, and shifting investor preferences. How has COVID-19 affected those various trends that were already in play?
Yeah, so I'll give an example. So if you think about it from a fee pressure standpoint, when we were looking at last year, again, it was a relatively strong year in terms of market performance assets under management. And we knew we were already seeing fee pressure. You fast forward into this year, and what happens is a couple of things. With the pandemic, if you think about specifically on the institutional side, oftentimes that sales cycle that's relatively long gets even more elongated, right? You also recognize that all of your asset owners or your investing clients are seeing pressure on their business. And so there's a natural shift then to think that much more intensely about fees or cost. And again, oftentimes it's not from the standpoint that they're necessarily demanding a concession, for example, on the price of the products. It's more so they're looking at how will they continue to move the portfolio into lower cost options that are going to be a benefit, because that's something that you can definitively count on if you save that money. If I think about the shift towards outcomes, really when we think about the marginal investor every day, right? The way that we would have talked about this in the 90s when we were in the business is you had this huge trend towards what was called the self-directed investor, the person that wanted to buy the hot stock or the fund. Now, it's not that we don't see retail investors in that way, but a dominant preponderance of investors increasingly want solutions that are delivering them an outcome, say for retirement or saving for a child's college educational expenses or those kinds of things. And they, in a sense, want it in one single SKU or product. And so they're willing to give up discretion in terms of choosing individual stocks or individual funds for the benefit of having something that's both outcome oriented, simplified, and more cost effective. So those are some examples of, as we've seen this more and more and people move to the digital environment, how those kind of trends get accelerated.
Sure. And one of the things I think that's made this industry so competitive recently has been the concentration of assets at the very top. So I wonder, what do you think about where growth is coming from, especially for the fund managers who might not sit in that top 3 to 5 category?
Yeah, so it's interesting. So if we think about the business, so if you track the business from, say, the financial crisis that we had, and so we saw some different and very identifiable things that happened as a result of that. We saw a huge acceleration of the move towards passive or index investments, right? And so that favored all index investments. And in particular, we saw that demonstrated in the dramatic growth that you've seen in exchange traded funds. And the vast majority of ETFs are index managed products, right? And so you saw that. We also saw commensurate that what you're referring to is, I would like to say it's kind of the not winner take all. You hear people say that. I like to refer to it as winner take most. But we certainly have seen a consolidation of the net flows among some of the largest providers. But what I would tell you that people don't tend to look into, if you peel back the flows and you were to look at gross flows, what you would see is actually significant shifts. So certainly we've seen some of the largest providers, usually those managers who have large index businesses, who are strong in areas like ETFs that are growing. I mean, you can think of those names that would come top of mind. But we've also seen providers over that same period of time, whether they're using quantitatively oriented strategies that are efficiently priced, and I can think of several names in that regard, all those who have moved towards what I would call more efficiency in terms of what they deliver and the price for which they deliver that, those have been relative winners in the environment. The last thing I would say in that shift that we shouldn't lose sight of, though, another large winner in the environment has been the shift that you've seen going into alternatives and more specifically private assets and private equity.
Absolutely. And I want to take a look at the active and passive tension that you were remarking on there. Bloomberg data shows that assets in actively managed mutual funds and ETFs still make up about 58% of those assets in the US. And that seems to have been steadily pared down over the past several years. I wonder, what do you think about whether this moment that we're in, with all the volatility that we've seen, whether that will change any of that shift that we've seen, a steady passive kind of march forward?
Yeah, so it's tough. So what I would lead with this. For me, it's not sort of a philosophical view. So I want to be clear. For someone who's been in this business a while and who loves the science of investing, I believe when investors deliver a true value proposition, so let's say for an active manager, and they're truly doing great informed research, they're in segments of the market where there's the opportunity to differentiate what they're doing from a strategy standpoint, and they're truly picking securities, right? They're not just closet following a benchmark. There's a value for that. There's a role for that. The challenge that we see is historically, many of the managers that we would identify as quote unquote active managers, when you look at the informatics of the actual portfolios that they manage, they don't differ materially from an index product or portfolio. And so the way you might think of it is those kinds of strategies, given their return profile and their costs, they're getting squeezed out of the market. And so if you ask me about then that trend, what I would call, again, increasingly a trend towards efficiency, do I see that abating? I do not, actually.
Got it. One more question on shifting investor preferences that relates to a different segment of the market. I want to take the time for a quick poll question for our audience. And the question is, will investors commit more money to sustainable funds, environmental, social, and governance-focused funds going forward? And the responses are yes, as long as returns are there, maybe, or not really. So let's just take one moment for our poll.
Sure.
And it seems like the overwhelming responses coming in are saying yes, as long as the returns are there. How is Northern Trust thinking about sustainable investing, and what do you make of that response? We've got about 67% of our respondents saying that yes, investors will be committing more money to ESG products going forward. So how is Northern Trust addressing that?
So a couple of things. So on this one, I would say I definitely am one that is betting with the wisdom of the crowd here. But I'll give some context for it. So for us, sustainable investing as a focus is not new for us. If I think about our nearly $1 trillion in assets that we manage, well over 100 billion of that are in sustainable investing strategies. And so it's a part of the market where we've had strategies for going on 30 years now. And so, but what's happened is more recently, there are a variety of things that I believe are permanently changing the demand curve for sustainable investing. And I think it will continue. So again, I vote with the 67%. First of all, as we see over time, what we've seen in most recent years, particularly in the last 5 years or so, there's much more better availability and sources for criteria for ESG. So environmental and social and governance criteria, the actual data that you need to evaluate companies based on that's increased substantially, right? You're also seeing an increase, this is very important. Investors have a fiduciary responsibility to clients, and they think about delivering that risk-adjusted return. But now when we see research being done, and we do this ourselves, where we can see the relevance of these, what I would refer to as performance indicators from an ESG standpoint, in driving risk-adjusted return, now there's more of a proof case to that today. So it's not just about the intent of the investor. There's a broadening of the investor demand for sure. If you look at markets like Europe, it's table stakes there. But now when we see the move afoot in the US and even different parts of Asia, that's important. And then finally, you see more of a regulatory or governance pressure in different markets around the world. All those things work together. For us, it's really integrated in what we do. We not only have the investment innovation and the strategies themselves, but what we're doing from a stewardship and a governance standpoint, going through how we think about the companies that we invest in, how we vote our proxies, all those different things. All of that is incorporated into a fulsome sustainability effort. And so people are not looking just at the efficacy of our investment strategies. They're looking at our thought leadership in that regard. And they're also looking to us for how we can support them from a stewardship standpoint. So that's what we've been doing at Northern Trust for years now. And I think that's what's driving the opportunity set for us.
Sure. And how do you avoid the risk of virtue signaling and greenwashing from some of these funds? What does it take for a sustainable fund to stand out from the pack with so many companies now launching these kinds of products?
Right. So a couple of things. So the thing I think that's most important is at the end of the day, right, you have to have a clear discipline to the investment science. And so if we're looking at any kind of investment, right, we're thinking about performance on three different axes, right? We're thinking about how does the strategy deliver against its investment objective? So there has to be a clearly stated investment objective, and there has to be articulated value delivered to the investor, right? The second thing is, how does that investment perform relative to, again, a risk-adjusted return? So think about the actual performance of it. And we're able to measure that, and we can look across categories and all those things. And then the final thing we look at it is relative to the other alternatives in the space, whether they be other sustainable investing strategies or whether they be other strategies that are not sustainable investing strategies. So when you have a clear emphasis on identifying those things, demonstrating the value proposition, and being clear on the measurements, I think that's how you avoid, in a sense, these concerns over quote unquote greenwashing or other things like that. It's actually simply stated, holding it to the same standard and measure that we would any other investment strategy or investment product.
And I wanted to ask you about the S piece of ESG, with the reckoning happening in America and all over the world over police brutality and racial injustice. I wonder, since the asset management community is so homogenous still, with just about 2% of executives in this industry being Black, how is Northern Trust thinking about this cultural moment? And what do you think that asset managers need to do to participate meaningfully in this movement?
Yeah. So a couple of things, and I appreciate the question you asked. First of all, the moment can't be a moment, it has to be a movement. It has to be driven both from a standpoint of a clear set of vision and values by a firm, right? So it has to be part of how you see the firm in its best future. That's your vision. And it has to be consistent with the deeply held beliefs of the company, the firm, embedded in that culture. And then, of course, it speaks to delivering whatever our mission is, including what we do from a financial performance standpoint. Now, when I think specifically of our journey, it hasn't been a moment for us. You know, I'm very fortunate in this regard to work with a firm where we're working on things and we want to improve. We've been committed and on a path to driving more diversity, equity, inclusion in all senses. So we start at the top. So that's the first recommendation that I give. And I think it's so important if you're going to drive diversity. So many people want to start at the bottom of the organizations. We started at the top. So if I think about my asset management executive team that we've been able to build over time, and I have the privilege of leading. So 9 of our 15 members on our executive team are either women or persons of color. And even if you wanted to speak specifically to African American, 3 of the individuals on the team. And so these are the senior most leaders of our global organization. And so we built that over time through a serious commitment to making sure that opportunity is equitable, both in terms of when we think about hiring and promotion. So that's the first thing, start at the top. The second thing I would say that firms need to do is you have to think about who you partner with and who you do business with. And if in a short review, you look at, your providers, the firms that you work with, the vendors, and there's no diversity among them, both in terms of the ownership of those businesses and even in terms of the employee profile of those companies, then you need to think about how you spend your dollar differently to drive that. So I think that's another important part of diversity and inclusion, because we can influence it in that regard if we're really committed to that. And then the last part of what we think about is what's the nature of the measurement that we're doing every day. So it can't be something we talk about, but it's not one of our most important focuses from a measurement standpoint. So for us, we have public scorecards we use in our business. We talk about where we are on these metrics all the time. There is clear accountability and ownership of it. It starts for me and my expectations that I have, and it flows through all of the senior partners in the business I work with. And so those are the primary things I would start with in terms of starting at home for people to drive diversity, equity, and inclusion.
More accountability, more transparency. We have another ESG question coming in from our audience. With the shift toward retail investment and the importance of the retail investor, At the retail level, do you expect that investment advisors are going to be encouraging their clients to move in the ESG direction? Do you think that that will be a focus from the advisor level?
Yeah, so I think you're going to see it evolve in different ways. One of the things I would offer is, with respect to advisors, we definitely see communities of advisors who are really interested in sustainability. But to be fair, it differs from practice to practice. So I do see that growing over time, especially because of some of the things that I mentioned in terms of the availability of criteria to evaluate these strategies, more relevance in the performance indicators. So you're going to see that continue to grow. But there's going to be, again, pockets where the growth is stronger. With respect to retail investors, I think what will happen is individual investors are becoming more assertive in terms of what they want with the impact of their investment dollar. So I think you're going to see, in addition to, in a sense, a push from the advisors, you're going to see a pull from retail investors. Now, that will be affected by different things. Like, for instance, there's some potential regulatory things that are afoot to suggest what sustainable investments should play, how they should play a role, rather, in, say, 401ks. So we'll have to see how those things play out. But in general, I do think you're going to see that push. And I think as we look further out into the future, I wouldn't be surprised if we're talking 3 or 5 years from now, and for certain investors, it becomes the marginal decision point. You know, the performance just becomes table stakes. And so I really want to know that once I have the requisite performance, that the investment mandate aligns with my personal values.
Great. And one last question before we wrap up for you. Consolidation was already happening in the asset management industry going into this year, with Franklin Resources and Legg Mason agreeing to merge and other major mergers. What do you think that the COVID-19 crisis and the fallout from it economically will mean as far as that consolidation trend?
So here's what's interesting. So what I mentioned in terms of one of the trends is consolidation of both buyers and sellers. So I can pick any segment of the buying population: registered advisors. I can pick intermediaries. You see a consolidation going on there. You also see it with the buyers, right, in terms of the providers, the asset managers. But the first thing I would say is much of the consolidation I actually expect to see is happening organically. You said it yourself in terms of how, quote unquote, the proverbial winners have gotten larger. And so I think that's going to be the biggest manifestation over time of the consolidation. Now, alongside that, do I absolutely believe that we're going to see more pickup in M&A activity? For sure. Because the pressures that will result in terms of the clock getting sped up will drive people to look, I think, more at certain inorganic opportunities. I think you have to be very mindful. We know over time that many of those M&A transactions sometimes destroy more value than they create. So you have to be really thoughtful, particularly from a cultural standpoint. But certainly we're going to see consolidation of the M&A kind. And I think we're going to see predominantly a consolidation of people taking share, and in a sense, the middle part of the market becoming more and more squeezed.
So expect that squeeze on the middle part of the market. Thank you, Chandran. That's all the time we have. I can't thank you enough for your time here today. Next up, we'll hear from Eric Balchunas, Bloomberg Intelligence Analyst, on what's next for ETFs.
Good afternoon, everybody. My name is Eric Balchunas. I am the Senior ETF Analyst for Bloomberg Intelligence. I head up a team of 4 great analysts who cover ETFs, both here and in Europe and ultimately in Asia at some point. I'm going to go over with you today some of the big issues and themes we're watching in 2020, which has been quite the year, very intense. I feel like it's been a couple of years kind of crammed into 6 months, and there's been a lot of ETF storylines that we've been following and things that I want to point out to you today. Just real quick, where you can find our data on the terminal is BI ETF Go. Not only do we have our notes there, which we publish on a daily basis, but on the left, there's a lot of cool stuff like flows. You've got scoring systems, a traffic light, a lot of goodies over there. I highly recommend poking around on our dashboard. Now, let's just jump right in. I think the big issue for this year was the sell-off. And every time there's a sell-off, we see the same thing happen. The going gets tough, ETFs get going. Their volume goes up and up and up. In fact, I always call SPY sort of the people's fear gauge. When you see SPY volume go up, it means people are very afraid and nervous. It means they're tweaking their portfolio. And here's SPY volume over the past about 15 years. You can see during the corona apocalypse, as we call it, for lack of a better word, it traded $113 billion one day. You can see that was the most of any of the big sell-offs over that time frame. And in general, whether it's equities or fixed income ETFs, all of them shattered records, specifically in March, but in Q1 as a whole. And this is something we see that where, things get tough, people will trade ETFs. They become a release valve, something they look for liquidity. So, that was nothing new. This is something that we have predicted because of past sell-offs, and it came true again. And when we talk about this volume, I think one of the things you saw in the sell-off was bond ETFs. And they saw a lot of volume. They basically smashed their volume records, but they also saw discounts. And this is a big issue, right? It's always an issue in these sell-offs. If you look at something like LQD, this is the discount to premium of LQD, and you go and you look at the recent one, it traded about a 5% quote discount. This was a little less than 2008 where it traded 10%, but it was very high or very low, if you will. This probably is all fake. We think the ETF is way closer to the true market. The NAVs are showing that they're stale in a crisis like this because they aren't reflective of where the bonds traded. Some of the bonds are stale. They haven't been priced. So the NAV tends to be lagging, the ETF's much closer to the real market because somebody would arbitrage that if you could sell those bonds. And there were no bids, and that's sort of the discounts we got. The volume to me speaks, quote, volumes about how ETFs are used by the professionals in these situations. If they didn't think that ETF price was close to a good deal, you wouldn't see this sort of large inflow of volume on these ETFs as they get used as a proxy for the bond market in these stressful situations. So as we also predicted, every time you see these sell-offs and crisis situations, bond ETFs, they all sort of grow flows after that situation because they're able to hold on to investors a little better than mutual funds, and the volume tends to bring in new audience, people who might not have used them before. So they've already grown by 90 billion since the end of March, and we expect them to keep growing to 1.5 trillion in the next 5 years. Now, corporate bonds in particular were a big focus because the Fed came in at the end of March and said, we're going to buy corporate bond ETFs and corporate bonds. And they started with the ETFs, which wasn't a huge surprise. ETFs are a little more liquid, and you can, shotgun and get all the bonds at once. They bought about 5 billion up to this point of corporate bond ETFs. That's about 2% of the entire corporate bond ETF market. Right now, they're going to start to shift over to the actual underlying corporate bonds, which we always thought they would do. But what's interesting is of that 5 billion, that's only about 10% of the 50 billion that went into corporate bonds in the past 3 months, which, as you can see, would already be an annual record. That's how much front running there was of the Fed. We've never seen anything quite like it. It was a feeding frenzy. We're curious how much of that front running money will hang in there versus take profit. So we're looking for potentially some headwinds here from profit takers. But for now, it does appear that people are really piling into the corporate bond area in terms of ETF flows. They have totally punched above their weight all year. Now, outside of these tactical trends of where money's flowing based on where the market's hot, we also see a general law of ETF flows play out year after year, which is dirt cheap and shiny objects. Almost all the money goes to ETFs that charge below 20 basis points, or ones that really crush it in terms of performance. And that's what this chart shows. If you look here, you've got cheap, deciles of cheap and performance. And the upper left would be best performing and cheapest, and the lower right would be the opposite. So you can sort of see the trend there. And the only way to sort of gather attention or get looks if you charge above that 20 basis point line typically is to have a great performance run, do something special that gets people's attention. But most of the money, again, just flows to that cheap stuff that makes up the core of your portfolio. And that's what you see from this chart here. And most of that money that's flowing to that area is going to the two issuers that everybody knows, BlackRock and Vanguard. We call them the duopoly. They account for about 70% of all the ETF flows each year. And they're like King Kong and Godzilla battling it out each year. Now, BlackRock has taken in more flows in ETFs than Vanguard for the past 6 years. but Vanguard is beating them this year. And it speaks to another theme we kind of predicted, which is bull markets are good for Vanguard, but bear markets are great. Every time the going gets tough, Vanguard investors tend to not leave the funds. And if anything, they actually go back in just like they would, rain or shine. They keep pouring money in. And that kind of behavior is very good because it is relative to all the outflows everybody else is seeing. So Vanguard tends to eat up market share in bear markets or sell-offs, and that's what we're seeing this year again. Although since the Fed stepped in, a lot of money's come back, and it's kind of snapped back to that normal situation. But I would say that in the next 5 years, look for Vanguard to pass BlackRock in assets if the markets are flat or down. If the markets keep going up, it will take a lot longer. But that's something that we are watching as well. Now, part of the issue with active and passive is how do active mutual funds benefit from the ETF craze? And this brings us to active non-transparent ETFs, which were just launched this year. We call them ANTs, and now there's 6 of them on the market. $200 million, slow start, but that's not, I can't hold that together. It's very hard to get assets early in the ETF market. But we are generally bearish on this because it's very difficult to, like I said, get attention if you're not really cheap or really crushing your benchmark. And I think a lot of these are going to be somewhat conservative in terms of how big of a bet they make. And they're all in the 40 to 60 basis point realm. And they're in the large cap equity space, which has traditionally been the area that is least receptive to active management. I think as the ants go to small caps and emerging markets, they could get more looks, or if someone has a great performance run, or if one of them comes in cheap. And a big problem for the ants is smart beta. Over the years, ETF issuers have taken active strategies, turned them into rules-based indexes, and then made ETFs track them for almost no fees. And so if you're an advisor and you're looking to do something different than a Vanguard fund, smart beta is a way to get active, and it's much cheaper. And so active ETFs traditionally have just had all their oxygen sucked up by smart beta. And I don't see how ants are going to change that, but we are watching. Now, we're also looking at ARK. ARK is a great example of somebody who does swing for the fences. This is Kathy Wood's fund. They've done a good job of being concentrated, bold, and convicted. The Tesla bet really worked out for them, and they've taken in flows, and they're high cost, and they're independent. They have no business taking in all this money given those other aspects, but they did it because they just crushed the benchmark. They didn't beat it by 2%. They beat it more like by 20, right? So that's something that I think active could do in order to buck that, sort of trend towards ultra low cost. And now ESG, look, there are record flows. We're semi-optimistic. I think some of these flows are not what they appear. Half of them are a couple institutions and BlackRock's own model portfolios. Only half is true grassroots. So it's something to look out for. We think that ESG is maybe a little overhyped versus the actual true demand from millennials who appear to like trading more than ESG. At least that's what we're seeing right now. And I also think ESG is a personal decision. It's hard to standardize what my values are versus somebody else's. So we think direct indexing could be better for ESG. And that brings me to my last slide, which is one of the more fun topics that we've been covering all year, which I call jet sanity. And it's the just unfathomable rise of this obscure airline ETF that nobody heard of. It was out for 5 years, nobody cared about it. Then it goes down 50% this year, and all of a sudden it starts taking in money every day for 70 straight days. That is a streak that is unheard of for a theme ETF. Only a Vanguard fund has done better than that. And what it really speaks to this situation we have with the reopening of the economy. So this little ETF has become a proxy for how fast you think the economy is going to reopen. It's also become fascinating because it sort of pegged a bunch of Robinhood traders on the other side of Warren Buffett, who sold his airline stocks in early May. And as of now, Robinhood is winning that. They're up about 29%. That's what Jets is up since Buffett sold. I wouldn't bet against Buffett. It almost reminds me of a 16 seed versus a 1 seed in the NCAA tournament, Buffett being the 1 seed. But this 16 seed has a good early first half lead. And so this has become an interesting situation. And it's also shown you there's a market outside of advisors for ETFs. And we keep seeing the Robinhood type investor grow as a distribution for ETF issuers. Another one came out this year, Bets, that does online gaming, had an instant hit there. So it's showing that you can actually have a hit ETF without even dealing with advisors. That do-it-yourself investor and trader is an area we are watching in the future as well. So with that, I will stop. And if you have any questions, please reach out to me or our team. And thank you for listening and have a great day.
Hi, my name is Julie Sheriel, and I'm a senior analyst with Bloomberg Intelligence. I cover equities in the fintech and payment sector, but I'm here today representing our entire U.S. telecom, media, and tech team. TMT is one of the clear beneficiaries of the behavioral shifts brought on by the COVID-19 pandemic. This shock has accelerated a digital transformation already underway, and we think the changes it's brought are here to stay. I'm going to touch on several topics in the next few minutes, but you can find them all in the digital theme book that we've sent to you. The first segment to see a pickup at the start of the pandemic was e-commerce. Most stores closed, and people sought to avoid the stores that were open. Because of the growth here, our retail team expects e-commerce penetration to double to 22% of US retail sales by 2024. The first wave of coronavirus drove Walmart e-commerce sales up 74% and Target's up 141%. Food and beverage e-commerce will lead the pack, and Amazon added 60% to its capacity here. Our analysts see it going from 60 billion to 160 billion in sales by 2024, driven by Walmart, Kroger, and Albertsons. And importantly, shopping online will stick. A MasterCard survey in May found that 47% of consumers expected to shop less in stores even after the virus subsides. Plus, store closings and bankruptcies are on the rise. Greater use and adoption of e-commerce is one factor driving digital payments. Another is a desire to avoid cash. It's just seen as the least hygienic payment option. So contactless payments at the point of sale are quickly replacing cash. Volume on tap-to-pay contactless cards jumps 20% for Visa already this year. But the bigger money-making opportunity here is with digital wallets. We see payment volume here growing 27% annually through 2023, which means activity will jump 2.5-fold. In the case of in-store payments, the primary digital wallets are Apple Pay, Google Pay, and Samsung Pay. Their goal is less about generating payments revenue, considering how large they already are, but more about driving handset stickiness and utility. But Samsung Pay just announced several banking-type services, and Apple offers steeper rewards on the Apple Card if you use it through Apple Pay. The second type of digital wallet is the P2P app. That's the original PayPal and the more recent Venmo and Square's Cash App, which suddenly can claim 27 to 37 million users each. They started out offering mostly free peer-to-peer payments, but they're shifting their focus to other services that can be monetized, like debit card issuance, Bitcoin and fractional share trading, and direct deposit. We think direct deposit is a killer app for these companies. If they become the gatekeeper of their customers' main funds, like payroll, then they become a hub for all of that customer's financial activity. And that's where the real revenue kicks in. Cash App has a jump on Venmo here, but we think Venmo will ramp up aggressively this year. The third type of wallet is an e-commerce wallet that comes from marketplaces like Amazon and Facebook and retailers like Walmart and Starbucks. So these are evolving from a checkout convenience to a driver of sales. They hold rewards and they capture data on customer behavior that makes incentives offered even better. PayPal started out as a P2P service, but has evolved to the leading e-commerce wallet. It has 300 million users, has its pay button on 70% of online merchant websites, and 89% of consumers say they've used it in the past year. As a pure play, it's in the sweet spot of the trend toward digital payments. Let's turn to some other areas of TMT and digital transformation. We have lots of interesting research here, but let me just give you a quick recap. Moving to the cloud is the cornerstone of digital transformation, and we expect enterprises to invest more aggressively once the pandemic subsides. Near term, this is about productivity and collaboration applications like Zoom and Slack and RingCentral. But it's moving to commerce and customer service solutions from Shopify and Salesforce, for instance. By 2021, we see companies investing in IT infrastructure to move to the public cloud with the likes of Microsoft and Amazon. The secular shift to the cloud, plus an increase in remote work, will drive growth of cloud-based security providers, especially as breaches get more sophisticated. So pure play cloud companies such as CrowdStrike, Okta, and Zscaler could grow 3 to 4 times faster than the overall security market, and more cloud-focused M&A is likely. Dramatic workforce changes with office closures have also put a spotlight on gaps in enterprise IT architectures, and companies are now under pressure to quickly catch up. They'll tap Cisco, Arista, and others after years of underinvesting. One sector battered by the COVID-19 is media. From closed theaters to theme parks, to sports being canceled and ad spending being pulled. But the pandemic has also accelerated the shift to digital media. Major streaming services added at least 50 million subscribers since January. And while Netflix added 16 million in the first quarter, traditional pay TV operators lost about 2 million. Nielsen reported that time spent streaming more than doubled from a year ago. And I guess this presentation is adding to those streaming hours. I hope our digital transformation here was worth your minutes and your bandwidth. Enjoy the rest of the conference.
Hey everybody, I'm Joel Weber, the editor of Bloomberg Businessweek. I'd like to introduce you to my guest today, John Stein, the CEO and founder of Betterment.
Howdy, Joel. Good to see you.
Hey, John. This interview is a Bloomberg Businessweek debrief, and it will appear in an upcoming issue of the magazine. So, John, thank you so much for joining me. Happy pandemic to you. Really important question I want to start with, which is, what should I do with my money?
You should bring it to Betterment, of course. If you're, but I my question.
I had a feeling you might say that, but it's such an obvious question, and the financial service industry has so many players. You entered this fray 10 years ago when you started Betterment. What motivated you to enter such a competitive landscape?
I saw lots of competitors in this space, and I tried most of them, right? I like to tell the story of back when I had graduated from college and I was working in financial services. I opened like 7 different brokerage accounts with like everybody who was out there. And what I found was all of those services were very good at telling me what they wanted me to do for them. So it was trade this, buy this fund, do this thing, but none of them were telling me what was right for me as a customer. And I thought it was time to build a service around what's right for the customer. These are your goals. Here's how much you need to contribute to reach your goals. You're on track and everything's okay. That's the kind of messaging that Betterment delivers, that we've innovated on. And now we've created a whole category, and it seems lots of folks are after this idea of a more advised, customer-centric future for financial services.
That's right. And, that category that you mentioned is basically a robo-advisor was sort of the shorthand for it. And we've seen that now with you for 10 years. And like I said, it started really in the aftermath of the financial crisis. You had 0 customers then, 500,000 now, 20 billion assets under management. And here we are living through another crisis. And I'm just really curious, you have such an interesting look on society and customers. How are Betterment customers behaving during the pandemic?
I like to say that we were born in a crisis like this, and we were built for exactly this kind of environment. In March, when the volatility was at its highest, all of our algorithms and automation kicked into high gear. We saw 8.5 billion of trading in that month out of our over 20 billion of assets. And a lot of that was two-sided trading, meaning we were, say, selling off assets that had fallen in value, or rather selling off assets that hadn't fallen in value to buy assets that had, which meant that when things rebounded as they did, our customers benefited a lot. That rebalancing made our customers a lot of money. We also were tax loss harvesting and taking advantage of all the opportunities in this environment. And that's when Betterment's technology is at its best. And we do that without customers having to do anything. So they can just stay the course. They're on track to their goals. When, if you talk to most customers, what they were doing at the time when the market was at its bottom, was they were selling, they were panicked. They were saying, hey, should I move everything to cash? And so we were born out of a time like this. We're at our best in a time like this. And our customers, we've been growing. March was also a record customer growth month for us. Q1 was a record quarter. Q2 it looks like we might set another record. So we've seen sustained inflows and continued customer growth, which is exciting in this time.
So the inflows, what do you project over the course of the year? What do you think it's going to look like for you and your business?
This is a particularly challenging time to project, with everything that's going on in the world. But we saw, for instance, in the worst time, we still saw 26% more customers making deposits than withdrawals ad hoc, right? And for millennials, it was even more, 37% more deposits than withdrawals. So across our entire customer base, and particularly for our younger customers, they're just continuing to deposit, continuing to grow their accounts with us.
So I think one thing that's really interesting about Betterment is you put a big emphasis on behavioral science and sort of appealing to a side of a brain that you might actually be tempted to suppress sometimes in favor of selling when things get really bad, right? So how do you keep people investing when the sky looks really dark?
One of the things that we've often heard is that when this next crisis hits, we're going to be really tested and everyone's going to run for the hills. We maybe heard that from financial advisors too, that what customers really need when things get rough is they need to call me. But I'll tell you, like, a lot of financial advisors are using our software, advisors like Josh Brown, and to actually help their customers make the most of times like this. And the advisor, of course, is providing value on top of that with the long-range planning and everything. But the software is doing a lot of the work of what technically needs to change in this moment, which is usually not a lot. And that gives the advisors comfort. It gives our customers comfort that their money is being well managed in any market environment. And behavior is huge. I mean, we've done a lot of analysis of customer behavior over time to help our customers stay the course. We've seen, for instance, that if we put red and green colors on gains and losses, customers are more likely to trade than if it's just in black and it says you're on track. So, in contrast to, I think, some apps and services out there that are really trying to gamify trading and like lean into the gambling element of it, which I think does appeal to a segment of customers. Betterment, true to our roots, is all about making the most of our customers' money in the long term and doing everything we can to help customers make the most. And that's generally not trade, because when customers trade, they tend to underperform the market significantly over time.
So I think that's actually a really interesting phenomenon in the pandemic, has been the kind of the resurgence of retail day trading, right? What do you make of that?
I think people are bored, and I think casinos are closed, and it's dangerous to go to these places where sporting events are shut down, so there's no sports betting. So people are just like looking for ways to like kind of let off that same kind of steam. That's okay. I think that's a very human thing to do. It's fine to do with small change. It just shouldn't be your primary investing strategy. And I think most sophisticated investors acknowledge and agree with that.
So do you guys talk about how you can convert someone from being sort of that day trader type into more of a long-term investor, especially with a younger crowd who may not have as much experience investing?
Yeah, I was one of those people, right? Like when I graduated college and I opened all these brokerage accounts, I had the experience of wanting to, read the financial news, understand which companies I might buy and go and invest. I learned the hard way, I guess, that even though, I knew better, I was out there buying some things that went really badly. I bought Enron on the way down, thinking, wow, this is a great deal, which is reminiscent of, maybe how some of the people are buying Hertz these days. I also made some good trades. I made some like really good investments, things that I bought cheap and made several times my initial investment on. But over time and on average in general, I also had some investments in just, mutual funds. And I found that those kinds of like index mutual funds were performing on average about as well as I was, even though I was investing all this time and stress in trading on my own. And I realized my best use wasn't to do this like, sort of day trading, but to pursue something else, with my free time. And I think maybe that's a thing that some of us just have to go through. And I think as a company, we, Betterment, ought to accept customers as they are, right? Like, come as you are. We're all human. We're all subject to these same kinds of behavioral biases. And like, let us coach you. Let us take your portfolio in and coach you over time to reach an optimal best allocation for your goals.
So one thing that your platform provides is the ability for investors to really personalize their portfolios and set goals. And I'm wondering, what are some of your favorite goals that?
Oh, there's some amazing ones. I mean, we have people saving for wedding rings and trips and babies and FU money and like all kinds of fun goal names. We just in celebrating our 10-year anniversary, we shared some of those. There's a page on our site that shares some of the best ones over the years because we've helped. We have over 500,000 customers, and for many of those customers, they've reached some significant goals. I think we had like 300,000 or 400,000 achieved goals over the last 10 years. Even though most of our customers are saving for very long-term things like retirement, they might have near-term goals on the side, be it safety net or something, that awesome, shiny sports car or whatever the goal name might be.
So that actually is an interesting way to bring up the fact that, a lot of it has been sort of under the guise of long-term investing, but this goal kind of idea allows customers to focus on, whatever they want, really, right? And one of the things that I think has been interesting is like you've moved closer and closer to sort of, frankly, being in checking and savings and like really looking like a bank, right? So what did moving into checking and savings, what did that accomplish for you? Why did you do it?
We've been talking about helping our customers reach their goals since we started Betterment 10 years ago. And one of the most important elements of reaching your goals is how much you're saving. In fact, it's the thing most in your control. You can't control what's going to happen to the market. You can't control what's going to happen to tax rates in the long term, but you can control how much you're contributing every month and every year. And so we realized that if we wanted to have the most impact for our customers, one of the most important things we could do is help them manage their everyday spending and saving better and make the most of that everyday money. And so from the very original vision, we talked about eventually getting into checking and savings. And we just finally did both of those things in the last year. Checking just a couple of months ago launched live to the public. And we've built this amazing service. I mean, we have a high yield savings account. We have ATM fees reimbursed worldwide. We have a fee-free checking account that lets you pay your bills, do mobile deposit capture, manage everything from your mobile phone. And it's already linked and integrated to this best in market investing and retirement solution. So it's very easy to automate all of your money, to have your paycheck come in and have a regular contribution going into your IRA, into your 401k, if that's with Betterment, your HSA. All of that can be integrated and is all working smarter for you because it's all working here for you better together.
So I want to take a moment and bring up a chart. And this one, it actually comes from some data that you guys got off of how people are using their stimulus checks. And I was really curious to know what was surprising to you about these numbers.
So what was surprising to me was that most of our customers are putting their stimulus check into savings and investments, right? Rather than seeing it come in and go immediately out, we saw customers saving it and banking it. I think part of that is because our customers are professionals, right? So they're not folks who are maybe living paycheck to paycheck. Maybe they were less dependent on this stimulus money. Maybe they didn't lose their professional services jobs, due to COVID. But they were putting it, many times toward safety net funds or retirement funds or like build wealth, and very little was going towards like a short-term savings goal. So I thought that was really interesting.
So John, I want to ask you also, we've seen so much attention on social injustice of late. Far more people aware of economic inequality. And I think one of the things about investing is that there's a lot of people who aren't. And I'm curious, when you think about some of these challenges that are on a social level, and here we have a chart showing the economic or the diversity of equity ownership, right? And so you can see how whites versus blacks or Latinos are really invested in equities. And I'm just really curious, like, how do you guys talk about getting more people invested?
I've seen some of this data, and it's striking, isn't it? That far too little of the wealth in this country is in minority hands. The numbers haven't changed enough. They haven't changed quickly at all. It's been eye-opening. So like many people in this time, I've just been learning and seeing what more we can do. And my team have a ton of energy around these social justice, equality driving initiatives. I think in part that energy comes from they're motivated. In part, it's what brought them to Betterment. Is we are a mission driven company. We believe that everyone should have access to great financial advice. We've always been open to everyone. We have no minimum balance. We have no minimum fee, and so people have always, we've always thought we're open to everyone. But now in this time, we're thinking even harder about what can we do to unbias our advice, to improve our diversity in hiring, to improve the diversity of those who are using Betterment, reaching new demographics and so on, because we have to do better than we have at moving the needle on some of these metrics, like the ones you're sharing in a slide.
Okay. So we also continue to face a retirement crisis, frankly, in the United States. What kind of policy changes do you feel are necessary to deal with some of these challenges that continue, just like what the topic that we were talking about, continue to sort of plague the country?
I think policy changes is ultimately what's needed to help people save enough for retirement. Something like only 11% of retirement spending today comes from personal savings. A third of it is Social Security. A third of it is people working in retirement. There's some other government programs and this and that, but very little is actually from investments. And yet, when you think about retirement, like the sort of conventional wisdom is, well, of course you have to save for your own retirement. It's just like a part of life. But it's really a small set of people who do that, and we all ought to be doing it. And yet, the behavioral economics side of me, and I know you have an interest there too. We know that just telling people to do a thing or giving them tax incentives to do a thing isn't going to drive real behavioral change. You just have to make it a smart default, like they do in Australia, where everyone is required to contribute to a superannuation fund. You have to decouple it from the employer. Why should this have anything to do with where you're working? It should be something that's available to everyone, that's portable across companies, where there's competition in the market instead of a single your employer choosing a single plan and everybody has to use that plan. We could do a lot better in policy around retirement. We've often said at Betterment that we are trying to build the feeling of defined benefits in a defined contribution world, right? Since the 1980s, we've been living in a world where pensions have been declining, and today almost no one has a pension anymore, unless you're a government employee. And everyone has a defined contribution plan, a 401k or something like this. But through technology, through smart advice, we can help people have the feel of, I'm on track, I know that I'm saving enough, even in that defined contribution world. And that's what making advice accessible to everyone is all about.
Right. So I'm really curious about how Betterment was really built on the back of the exchange traded fund, right? And you basically have a bunch of ETFs and then you layer advice on top of it with customized portfolio, if I radically simplify what you do. And I'm curious, could you have built Betterment without the ETF?
there's no way. We're standing on the shoulders of giants, and thanks to those who came out with ETFs and popularized them. When we launched in 2010, it was just at that inflection point where ETFs were broadly enough adopted and liquid enough that you could have a product like Betterment with a globally diversified portfolio all through ETFs. Really, like, even in that year, it was a little hard to get emerging markets equities, through ETFs in a low cost way. But very quickly, 2011, 2012, you could hit every asset class. And we couldn't have existed before because buying mutual funds meant building a pipe to each mutual fund manufacturer. And that was a very expensive undertaking. It's still hard. I mean, we still, we support DFA mutual funds for our advisors on the Betterment for Advisors platform. But it's hard to build all those bespoke pipes. And so we don't. We just use ETFs. And you can do everything with ETFs now, and they're more efficient, and there's price competition because of them. And we've seen the prices of them come down since we started, and we've driven those prices down through negotiation with our ETF providers and passed those savings directly on to customers. So this revolution of advice depends on ETFs, but there's another revolution coming, which is, today we can do so much, amazing accounting within a personalization, but I think that we'll do even more. We're hearing more and more calls for socially responsible investing, or women-led investing, or Black-led investing, and leaning into that, building like truly personalized portfolios with specific stocks for specific clients that still track an index. That's clearly where things are trending in our view.
So does that mean that you won't need ETFs?
ETFs are an efficient way to get an index, but I think that for those who want to personalize that index for any reason, there will be more small separately managed accounts or direct indexing. People call it different things, but how we personalize an ETF to someone really involves buying the individual stocks to track that index and tweaking them a little bit.
Okay. So how else do you want Betterment to innovate going forward?
We're leaning heavily into that investing area that we've just been talking about around personalization. We're doing much more around your cash management and automating the flows into your various accounts. We've already launched our two-way sweep, which through cash analysis that we do on your checking account, figures out how much cash you need in that checking account to cover 21 to 35 days worth of expenses, and always maintains that much by looking at your bills, by looking at your paycheck in a real time way, and then sweeps all the rest into savings. And then if you have a big bill come up, or you need extra cash, it automatically sweeps money back into your checking account. That kind of smart automation that just lets you kind of it puts things on autopilot. Is the future of all financial services. It's so you don't have to worry about it. You just know you're on track. And automating your savings is where we're spending a lot of time today.
Okay. So one of the things that between what you were describing and how you're viewing the future of sort of indexing and the sweep stuff is like it seems like you're almost transitioning into even more of a direct to consumer business. And I'm wondering how you're kind of preparing for that and where you're getting inspiration to apply to your business.
Yeah, we've looked a lot at models like ING Direct, the great old online bank, and Vanguard were a couple that really influenced me at starting Betterment in the first place. We look at retailers like Zappos or Amazon as folks who are customer centric and constantly driving innovation around the customer, and customer service centric in the case of Zappos. And we, I think that when I hear when I think about mentors who've inspired me, I think of maybe Bezos on the retail side, or Jack Bogle on the investing side. And Jack said to me, when I first met him, and again more recently, you're going to help a lot of people with this, and so that's been inspiring and encouraging along the way.
So I also, am just wondering about there's been so much downward pressure on fees, and I'm wondering what you expect that to look like for your guys' model, and will fees continue to be where they are, or could you see downward pressure on your business model as well?
We've seen downward pressure on fees. A lot of that has been the move from active funds to passive funds, right? And passive funds are lower cost to operate, and so by cutting out the costs, the price comes down. We've seen less pricing pressure for advice fees. Investment advisors have not been really reducing their fees. And in part, that's because investment advisors are expensive. And these are people who understand how to talk to clients, understand how to manage a portfolio. The technology that they're using, and that's what we provide in the Betterment for Advisors side. The costs there are probably coming down. At least ours have been, and so we've been passing that on to our advisors. And yet, people are, these are highly trained people who are expensive, and so the cost has been the same. Where I see the next price battle, I hope, is around banking services, because I think banks charge too much in nuisance fees. They try too hard to push people into debt. They don't pay people any interest on their savings, and those traditional ways of making money off of people's weaknesses, really, of their bad behavior, I don't think is aligned with the kind of society that we want to create, where people are empowered to manage their own money. If you had a great advisor, an advisor would tell you, don't pay these fees, don't go into debt, earn something on your savings. And as a great advisor, we're trying to drive that price competition into banking and everyday cash management services.
Okay. What goals do you have left for yourself here?
We have so much work to do, right? So, I talked about some of the things around investing in cash, and that's really just, we're still that's a 10-year horizon, right? If we really nail those things, it's taken 10 years just to get this far. But longer term, how do we think about insurance and tontines and smart, responsible kinds of lending that really are good for people? There's more to do in the financial world to help people live better, and those problems will continue, and we'll continue to solve them with smart technology.
How do you feel about going public?
I've always wanted us to be an independent public company. It's been my ambition from day one, and we're moving along that path. We're continuing to grow and attract customers at an exciting rate. Ultimately, this is like a scale game, and for us to be a large scale player, we're going to have to be a public company someday.
Any sense of what that timeline might look like?
Not today, no. Yeah.
It's a weird time to have that conversation, no doubt. I also want to ask, I'm sorry, say that again.
I was just saying it's interesting that all the public markets for IPOs do seem to still be open. We are seeing some companies coming out.
So 10 years on here, I'm wondering, what advice do you have for your younger self?
There are so many. I mean, I do a lot of mentoring. I do a lot of chatting with people who are starting out. It's something that I enjoy. Some of the problems feel solved, but they never really are, right? There's always more innovation in this space. Just go and build it and make it real. The technologies just keep getting better and better. And I like to say that, in our space, what customers want is performance, convenience, and peace of mind, right? And as long as we just keep investing in those themes, we're always going to be attracting more customers and doing better for them. But we spend all of our time and resources pursuing it, and there's still other people who who are innovating. So there's plenty of opportunity out there. Go after it, make it real.
Final question for you, John. How often do you actually look at the stock market?
It depends on how bad of a day it's been, but I generally don't. One of my uncle calls me sometimes and says, I assume you saw what happened in the market today, and I always say nope, because my investments are with Betterment. I do not look at the day-to-day ups and downs. In March, when things were, looking really bleak, like a lot of Americans, it was hard to avoid because our various publications were having, the headline on the front page when you went to the homepage was, S&P tumbles, and so you can't avoid it on days like that. But by and large, I don't have to. I have a financial advisor. It's called Betterment.
All right, John Stein, CEO of Betterment, thank you so much for joining. And thank you to all of you for joining on this final day of Invest Global. We hope you enjoyed these discussions and we welcome your feedback. There's an exit survey that will appear on your screen at the end. All sessions across the 3 days and from every region will be available on demand in our Bloomberg Invest Global Event Hub. Also in the hub will be video recaps of all 3 days and research materials from Bloomberg Intelligence. Those of you who joined us today in the hub have immediate access using the login you used today. For those watching elsewhere online, please visit bloomberglive.com/invest to access on demand. Thank you again to our fantastic lineup of speakers. And I'd also like to thank our sponsors for helping make this event possible. They are US founding sponsor, Invesco QQQ, Europe sponsor, CMC Markets, Middle East Africa sponsor, EcoBank. I encourage all of you to visit the Resource Center in our hub for more information from these companies. You can follow us at Bloomberg Live on Twitter and LinkedIn for updates. And please also be sure to follow our ongoing financial and markets coverage at Business, at BW, and on Bloomberg.com. If you haven't already, please also consider subscribing at Bloomberg.com/subscriptions. Thank you and have a great afternoon.
Hello, everyone. Thank you for joining us for our first ever live virtual mortgage strategist roundtable. I hope everyone is safe and healthy in these trying times. My name is Jeff Hinkst. I'm part of the mortgage specialist group at Bloomberg. Today marks my 77th work from home day, and I'm sure many of you are in the same boat. Dealing with unprecedented market dynamics, coupled with work from home and family obligations, has proven to be challenging for all of us. The need for more in-depth analytics, as well as insights into the markets, is more valuable than ever. Up until now, our group has been focusing on webinars in the mortgage and structured products markets, focusing on functionality and in-depth analytics pertaining to the COVID environment to further stress what-if scenarios for your securities. Today marks the first in what I hope will become a series of pure thought leadership and insight content. The goal is to bring you all informed opinions from subject matter experts in the market to help you formulate what are those possible what-if scenarios. Joining me today will be 4 of the top mortgage strategists on the street, as well as a senior economist from our Bloomberg economics team. Today, we'll be focusing on the agency mortgage market, and future sessions we hope to cover other asset classes such as CMBS, CLOs, CRTs, and non-agency RMBS. We will break out today's session into 3 separate sections. First, we will address the impacts of the housing market and prepays due to the COVID pandemic. Next, we will discuss the Fed's role in the markets and its impact on QA4. And finally, we will get to hear our panelist outlook on prepays and expected performance going into the second half of 2020. We will also, at the start of each topic, present the audience with a polling question I ask you all to answer. I will be reviewing the results at the end of each of the 3 segments. Polling questions will appear on the slide deck portion of your screen and will stay up for 1 minute only. So please answer as soon as you are prompted. If time allows, we will also do a short Q&A period at the end, so feel free to submit questions as they arise. If we don't get to all the questions, we can assist in setting up some one-on-ones with the panelists, so feel free to reach out to myself or any of the panelists directly after the presentation. So on to some housekeeping notes. You will see a series of icons on your screen. And on this slide, it gives you a brief description of the icons. This platform is customizable, and you can drag the corners out to expand, collapse any of the three boxes. You should also see the polling questions pop up with answers you can click to select. This will be in the top right corner. You'll also have the ability to submit questions, and this will be on the bottom right corner. So now I'd like to officially welcome and introduce our participants. Stephen Bergantino is the head of mortgage index models in our engineering department and leads the group that developed and maintains the Bloomberg agency mortgage index prepayment model. Steve is going to be our moderator today, so thank you, Steve, and welcome.
Hello, everyone.
And okay, starting with our panelist, Vipul Jain.
Hello, good afternoon.
I think we may have lost Jeff, but thank you for having me, and thank you to everybody who's joined.
Next up, Walt Schmidt, Senior Vice President, Head of Mortgage Strategies at FHN Financial. We're going to bring up Walt picture. There you are, Walt. Hey, Walt. Thank you very much. Welcome. Yelena Shoya-Taiva, Senior U.S. Economist in our Bloomberg Economics team. Thank you very much. Welcome. And Brian Yee, Managing Director and Head of MBS Research at JP Morgan. Welcome, Brian, and thank you all for joining us today for this inaugural event for Bloomberg. Very much appreciate it. Excellent. Okay, so now it's time to kick this off. Our first topic will center around the impact of COVID-19 on housing markets, mortgage rates, and prepayments. I'd like to first direct you to the first polling question that should pop up on your screen to get your own opinions on the topic. And then we're going to pass it over to Steve. So the first question, assuming that the 10-year Treasury yield remains near its current level of around 70 basis points, where do you expect the Freddie Mac 30-year survey mortgage rate to stabilize, currently at 3.13? So A, less than or equal to 2.5%, B, 2.5 to 2.75%, C, 2.75 to 3%, and D, greater than 3%. So if you could all take a second, answer that question. And with that, I'm going to turn it over to Steve for the first question of the panelists.
Great. Thank you, Jeff. And thank you to our panelists. I would like to reiterate how excited we are for our clients to hear from such an accomplished group of MBS experts. We hope that today marks the first of many such forums. And now, without further ado, let's dig into our first discussion topic. So looking at recent prepayment surprises, Walt, let's begin with your take on recent prepayment reports. What do you think has kept prepayment rates so elevated in recent months, despite the impact of the pandemic on employment levels and on face-to-face interactions, and the muted response of survey mortgage rates given the rapid decline in Treasury yields?
Certainly. Thanks, Steve. I appreciate the question and appreciate the opportunity to join everyone in the webinar today. I know Vipul has a lot of interesting things to say about technology, to say about servicer motivation and different things like that. I just want to make a very simple observation about elevated prepayment speeds, or at least elevated relative to expectations. There's been a lot of talk recently about wide primary-secondary spreads. And of course, the wider the primary-secondary, you would expect that prepayments would be slower. But if you look at the Freddie survey rate over the last 3 months or so, it's been anywhere from about 310 to about 330, even a little bit higher than that in March. Yet when I look at some of the new issue pools that are coming out, particularly 30-year 2% pools, I looked at the major pool for May last month. And if you take a look at that, there's 28,000 loans in that pool. And the bottom quartile starts, or is at the bottom level of 3%. That means that 25% of that pool, or 7,000 loans, have a 2 handle in terms of the mortgage rate. So the issue right now, one of the issues is that the rate that is being shown to various borrowers across the spectrum is very different one from another. And so it becomes very difficult for prepay modeling and for investors to get a sense of prepayments, because prepayments don't happen at the average rate. Prepayments happen at the margin. So there are a lot of marginal borrowers that are getting very much a low rate relative to the first polling question. What's the average survey rate going to be is an important question, but there's a lot of diversification among rates that are being shown to different borrowers. And so I think that those rates were surprisingly low, and therefore prepayment speeds were surprisingly fast.
Thanks, Paul. Vipul, what's your perspective on recent prepayment prints? Do you see the increase in the use of property inspection waivers as playing any role, or any other changes in efficiency in the mortgage origination process?
Thanks, Steve. I would say from my perspective, last couple of prepayment reports have been very, very interesting. And I would highlight like 4 or 5 key themes from those reports. First of all, I would say the primary secondary spread is really wide. What it means is making a loan is incredibly profitable for lenders. So even if you think about an inefficient lender, they have a lot of incentive to make that loan. At the same time, rates are all-time lows, so the media effect has picked up as well. So I would say that was responsible for the spike in refi index that we saw early March. The second thing I would say is that during early April, late March, there was a big short squeeze on the originators. So they had a lot of pressure to close the mortgages as soon as possible and deliver those mortgages out into the short. So I think that really created a sense of urgency to close those mortgages. To your point about property inspection waiver, that clearly is, I think, a very, very important dimension. What we have noticed in the data as new disclosures have come in, there has been a lot of convergence along multiple dimensions. So if you look at the PIW data last year, Fannie Mae loans, they were almost 10% higher adoption rate for PIW versus Freddie Mac. What we have seen this year is that Freddie Mac has pretty much caught up to Fannie Mae. And if you look at the percentage of loans that have taken advantage of PIW, among refi loans, it's almost 45%. The other thing that we have noticed within the loans is that the laggards among the various lenders have actually caught up with the leaders. So if you look at lenders like Quicken, United Shore, relative to that, other lenders like large banks, they've caught up in terms of usage of PIW. The other quick thing to remember is that GSEs, because of COVID, have taken enormous steps to really ease a lot of friction, especially around notarization, around appraisals. That has also helped with the efficiency. And finally, I would say one thing that is very, very important to realize is that the cash window program by the GSEs played an incredible role in maintaining the liquidity in the agency MBS market. And when we compare conventionals versus Ginnies, I think the edge from the cash window really stands out. And our view is that part of the reason conventionals picked up so much more than Ginnies is that there was no sort of cash window program on the Ginnie Mae side.
Interesting. That's very interesting. It is striking how the large jump in unemployment has had such a muted impact on voluntary prepays. Looking forward, buyouts is a significant source of uncertainty, and one would expect that the path of unemployment would likely play an important role in the resolution of forbearance plans, both in the level and the timing and the distribution of non-payment into buyouts or repayment. So to try to set up people's views on this, Yelena, it'd be great if you could give us your current outlook for the shape of the recovery in labor markets vis-a-vis the unemployment rate, and what you see as the primary risks to your forecast.
Sure. Thanks for having me for your discussion here. So in our baseline economic outlook, we expect U.S. economic growth to decline by 6.5% for the year as a whole. And we don't expect the unemployment rate to decline significantly below 10% by year end. So just as a comparison, we saw 10% unemployment rate at the peak of the Great Recession. So the data, the high frequency data so far have been showing quite a rapid rebound from the bottom that we saw back in April. However, it's just the beginning. It is the sustainability of the recovery that remains a significant question, and the labor market will play a significant role there. So what we have seen so far is the recovery that has been supported by significant fiscal support. However, I think that insufficient and delayed fiscal support going forward may actually delay the recovery going forward and weigh significantly on economic growth towards the end of the year. And obviously, a lot will depend on the outlook for COVID cases. Any reacceleration in the infection rates will significantly impact economic outlook and the labor market as well. So we see kind of an inverted Nike swoosh sort of a recovery right now, when we see a significant pickup in the near term, but then it slows down significantly, and the recovery in the labor market will be painful and slow in our view.
Yes, thank you. It does seem that the recent uptick in cases does not bode well for the longer term outlook for unemployment, at least over the next 6 to 9 months or so. Building on this, Brian, how do you see the weakness in labor markets translating into borrower delinquencies and forbearance plans? And do you expect the majority of forbearance plans to result in repayment plans that avoid buyout? Or are you more pessimistic and expect that borrowers are going to require more significant modifications and lead to buyout-related prepayments?
I think that's Brian.
That was a question, Brian, but
technical difficulties. Okay.
Yeah.
Okay. Thank you. I think that we are starting to get some numbers on forbearance plans. I think that the delinquencies, both from all the agencies, I think so I start off. I think roughly around 9% of agency borrowers have requested forbearance plans. Now, at the end, I do expect most of these forbearance plans to result in loan modifications, perhaps permanent loan modifications. I think if you're more credit impaired, you're likely to have faced more than the wealthier sort of GSE borrowers. And on the other hand, in addition, we are still looking at, like Yolina said, the unemployment. I think that unemployment will be the key to drive what will happen to both the forbearance plans and delinquencies going forward. I think that it may not look that pretty. In my mind, I think that so ultimately, we are, as analysts in our space, we're getting more concrete data on GSE forbearance plan, GSE delinquencies from Fannie Mae, Freddie Mac, and Ginnie Mae, and I think that they definitely bear watching going forward.
Yeah, and it does seem like it will be hard for the workout of forbearance plans to avoid buyouts and more significant modifications if there isn't a strong recovery in unemployment. Satish, what do you see as the key differences between the Ginnie Mae and GSE sectors in terms of both borrower credit and forbearance-related policies? And how do you see these differences manifesting themselves in terms of different paths for buyout-related prepayments?
Sure. So the differences start with the magnitudes on borrower performance. The MBA data recently shows 12% of Ginnie Mae borrowers in forbearance, half as many, 6% on the Fannie Mae side in forbearance. The second difference is that we're seeing in aggregate about a third of the borrowers that are continuing to stay current, that are in forbearance, about 20% on the Fannie side, 40% on the Fannie side, and 20% on the Ginnie Mae side. On the forward-looking view, one thing I would mark on the forbearance data is it remains to be seen once the stimulus checks end at the end of June, whether we get another hit on forbearance. So even though the MBA data has started to level off and decline this week. The second you mentioned is on forbearance policies. The first striking difference in a world where we have single security and alignment between Fannie and Freddie is the fact that Freddie Mac does not require servicers to report loans that are in forbearance but current. So we're only able to estimate these numbers on the Fannie side. And I bring it up because we're talking about a period where single security kind of needs to seal in the path forward. And so on the reporting side, that does put us at a disadvantage on the conventional side. The second is on the buyout side. And the key difference is the economic incentives on the Ginnie Mae side. Because it's the Ginnie Mae servicers who will conduct the buyouts, and they have at least 4 different incentives. On the Fannie and the Freddie side, it's the Fannie and Freddie that would conduct the buyout. So for the Ginnie servicers, it includes, firstly, as reducing cost of funding. It's cheaper for them to go ahead and fund on balance sheet than to pay the coupon. They secure the credit outcomes for the borrower. They restore the value of the MSR, and they capitalize gains on sale if they are able to get these borrowers to reperform. So there are striking incentives for Ginnie Mae. We expect Ginnie Mae buyouts to start showing up in speeds as early as June. We expect CBRs to be about 11 CBR, 7 CBR higher month over month, particularly driven by banks who are very efficient in conducting buyouts. For the GSEs, their policies state that they will not buy out loans in forbearance. And related to COVID-19, they indicate a 24-month period, so 12 months of forbearance, 12 months of payment deferral before they conduct buyouts. However, there's an out there for buyouts, which creates uncertainty as should borrowers be modified prior, and low rates could help servicers modify these borrowers, then those loans could be bought out as well.
Thank you. That's very interesting. I'd like to get a take on people's views of what happens longer term, I guess, during the post-COVID for particularly for voluntary prepays as we get past sort of these more immediate effects. So, Elena, let's start with you in terms of your longer-term outlook for existing home sales and home prices going forward. And we've already seen a pretty steep recovery in purchase applications, and it would be interesting to see if you think this is indicative of a V-shaped recovery in the housing market or more of a blip in something less durable.
I would say more of a blip. I would not call it a blip. It was actually quite, it was expected. So what we see right now is sort of a swing between a significant decline amid lockdowns and recovery in economic data just simply due to reopening of the economy. So think about it as some sort of a swing due to a hurricane. So what happens is that the activity shuts down, and then when the hurricane is over, everything reopens and you see a pickup in activity. It's just on a much larger scale what we see right now. So I think going forward, demand for housing will be capped by both supply and demand factors. On the supply side, there will be a lack of available inventory, and obviously on the demand side, the unemployment rate, high levels of unemployment rate will weigh significantly on that part. In our projections, we see 3 years until the economy is back to some sort of pre-crisis levels, and that's a long time. So I think that, both Satish and Brian talked about forbearance rates, and we all know the statistics from the Mortgage Bankers Association. It's more than 4 million homeowners are in forbearance, and more than 8% now are in such plans. And many rely on augmented unemployment insurance benefits. So what happens when this fiscal support expires? It will depend on how much it is extended. And I'm not very optimistic about the outlook going forward. I think in aggregate, I expect a slowdown in the pace of home sales, probably not to the bottom that we observed following the housing crisis. And I also see a deceleration in home prices as well. Some areas may benefit because of labor market mobility. We see this going on right now. So people are moving around. So some areas may benefit at the expense of others. But in aggregate, I see a slowdown in both housing demand and housing price growth.
Okay, thank you. It does seem that the forecast for employment and housing markets is not nearly as strong as what we're seeing right now in terms of prepayments and refi activity. Vipul, I'd like to get your sense. And one other place that we see that is also in mortgage rates. Anybody who follows survey mortgage rates has seen that they've responded much less to the decline in secondary market yields than one would have expected. So, Vipul, it'd be interesting to get your take on your longer term outlook for mortgage rates and prepayments. On the mortgage rate side, what do you expect the extent to be to which the spread between mortgage rates and benchmark rates such as par coupon or treasury yields tighten towards historical levels? It looks right now like we're about 70 basis points wide relative to what we would normally think. How much do you think will tighten in, and how long do you think it will take to get there?
Right. So I think when I think about what has happened in primary, secondary space over the last 2-3 months, in my mind, it's perfectly normal. We saw exactly the same phenomenon play out at the onset of QE3. My expectation, which in some ways in line with what you see, how the primary secondary spread modeled. Basically, what you see is typically a 6-month decay function with a half-life of 6 months. Like you have an exponential decay with a half-life of 6 months. So if you think about primary secondary spread blew out late March, early April, from that point on, I expect it to normalize over a course of 6 months. So another 2-3 months. And my expectation is that the mortgage rate stabilize somewhere around 2.75%, which is in line with what we saw from the first polling question that you have. So I'm right in line with that. As far as the prepayment outlook is concerned, I think there's a lot of different moving parts. I think as far as the short-term speeds are concerned, I expect what we have seen to persist. I think the current fast speeds are here to stay, at least in the near term, for next 2-3 months. I would say the thing to watch out for is that I expect the Gini voluntary speeds could pick up more in next 2-3 months. As I mentioned earlier, I think the liquidity impact has been greater on the Ginnie Mae side as some of the large correspondents sort of backed away from the market. As liquidity is restored, those guys come back, and we expect the callability to pick up on the Ginnie Mae side. The other thing that I would say to watch out for is, which was again very, very interesting over the last 2 months, that even though we had faster than expected speeds, it was not driven by TPO channel. We saw fast speed across the channels, we saw across the geos and across lenders. And if anything, some of the brokers actually stepped away. So what you could see over the next 2-3 months, brokers coming back, and that could provide a tailwind to the speeds in the near term. And that's something to watch out for. And finally, I would say, I think all the developments that we have seen over the last, call it 6 months, are here to stay. The mortgage lending efficiency is going up. There's more technology all around. And I think fundamentally, the convexity of mortgage universe has worsened.
Thank you. So, Brian, if you look beyond, like, say, the next 3 to 6 months, how important a driver of housing turnover and refinancing activity do you expect unemployment to be? Yelena was saying that she expected unemployment rates to hover around 10% for some time and to take 3 years to get back to pre-crisis levels. Do you see this as impeding prepayments longer term? And what do you see as the trade-off between this and the increasing efficiencies in the mortgage origination process that Vipul just alluded to?
I mean, I absolutely agree with a lot of the most of what Vipul said. I think that there's a lot of confusion going on over the last 3 months. I think that the refinancing machine was working perfectly well until March. I think that prepayment expectations were basically off key for the street for 3 months in a row. I don't remember ever having seen that. Now, longer term, it's definitely interesting because digitalization of mortgage originations, what he called PIWs, which is basically computerized valuation of home prices, have sort of taken hold. And over the medium term, I do wonder whether GSEs are going to keep that engine going. And the PIWs, are basically based on two parts. One is what the borrower's credit is, and number two is what the home value or LTVs are. I think that there's a GSE trying to strike a balance between the two. I think that for the policy announcements that they have announced over the last 2-3 months, just in response into this all chaos, is number one, to keep the pipeline of loan closings going, and number two is to take out cash out refinancings. And I think that we are starting to see that. We'll probably start to see that over the next several months. I do think that rate term refinancings will be going strong, and I think that originators will be competing for that business. We also saw that the housing turnover overall is still down, which means that baseline prepayments are down. And it really remains to be seen how this goes. Over a longer period of term, I think that, yes, I do believe that mortgage originations will get more efficient as digitization will take hold.
So I think that ties up our question and answer for the first topic on prepays. Jeff, I think you wanted to review our polling.
Yeah, thanks, Steve. I'll do a quick review of the polling question. I think the audience was able to see the results on the screen. 50% has answered, 2 3/4 to 3%. I think the most interesting thing is we've got 34% of the attendees think the rate could stabilize, somewhat below 275, which is a pretty decent drop from where we are now. So appreciate all the answers there. And quickly moving on to section 2 so we can make up a little bit of time. Section 2 is going to be centered around the Fed and the role that it plays in regards to the market with its QE4. Second polling question, which should pop up on your screen. Looking forward, what level of Fed MBS purchases best balances the goals of lowering mortgage rates and maintaining access to mortgage credit while minimizing distortions in the secondary mortgage market? I'm not going to read through the answers. You can read through those on the screen and please select your answer. And Steve, back to you.
Second topic is going to focus on QE4, the Fed's monetary policy, and in particular, contrasting it to QE3 during the financial crisis and its impact and their views on its impact on the broad economy, financial markets, and in particular, mortgage markets going forward. So let's start with Yelena for the broad economic picture. Yelena, please describe what you see as the key differences in size, in timing, and structure between QE and QE4 and QE3, and what has been and will be sort of you think the impact of these differences on financial markets, more specifically, and on the overall economy.
Sure. So I think, first of all, the key difference between the response from the Fed during the financial crisis and the pandemic response has obviously been the size and the speed at which these measures were implemented. So at the onset of QE3, the Fed was basically buying 40 billion of MBS and 45 billion of treasuries. And that was a monthly amount of purchases. So during, at the very beginning of this round of QE, the Fed was buying more a day than they were buying back then per month. So we actually estimate the overall size of QE4, including both MBS and treasuries, will be comparable to the total of the 3 rounds of previous quantitative easing programs. So the effectiveness of QE policies have been a big question back then. It's still a big question now. It's very hard to measure using empirical evidence. You know, the Fed says, well, you can just kind of guess what would have happened had we not initiated those programs back at the time. But just keeping that in mind, I think it's fair to argue that the previous round of QE purchases was effective, particularly the first round of QE was effective in a sense of, there was a big surge in refinancings, and that led to a significant improvement in consumer balance sheets that cleaned up consumer balance sheets very much at that time, and led to a significant improvement in consumer spending in the expansion, in the previous expansion at the later stages. So I think it's fair to say that those were quite effective. It took a long time, though, to really lower the mortgage rate back in the day, and it took 3 rounds of QE, essentially. So I think this time around, QE policies were effective in lowering the 10-year treasury yields. We saw a significant decline, obviously, around 1 percentage point. But as we know, that did not lower mortgage rates as much as the Fed would probably want to see that. And it has to do with the primary-secondary spread. I would argue that maybe because this time is different, economists should not say this time is different, but I would probably say that is because the spread between the 10-year treasury and the current coupon is kind of very tight. It's really the spread between what home buyers are paying and what investors are requiring is very wide. And perhaps I'm in the camp who are expecting mortgage rates to kind of stay elevated relative to what we see in the treasury market. This is kind of our view, and this is really nothing much the Fed can actually do about it, rather than just being there and making sure that everybody knows that the Fed is there in the market. They will do whatever it takes to keep the economy going forward.
Yes, there's no doubting that the Fed acted forcefully and in size this time around. And as with the past rounds of QE, the impacts on financial markets tend to be much quicker and more dramatic than the impacts on the real economy, which tend to take a longer time to play out. And I think within our small space of agency mortgages, where we've seen that the most has been in mortgage rates and the primary secondary spread, and the delays in sort of mortgage rates responding to the decline in treasury yields. But there's no doubt that their purchase behavior has had a strong impact on the secondary market. So Satish, when you look at the Fed sweeping up more and more of the non-specified pool market through their MBS purchase program, how do you see this affecting net mortgage supply, MBS spreads, the roll market, and spec pool payout?
Sure. So let me start with our updated mortgage supply forecasts. We just updated the 2020 forecasts for gross supply to be 2.65 trillion from our prior estimate of 2.55 trillion. And our net supply is higher. It's 260 billion versus previously was 227 billion. The driving factor is that the overall refi volumes have increased, and we are seeing with that an increase in the cash out volumes, not the share of cash out. So there's not greater propensity for cash outs. It's just that the overall volumes are higher, and that's driving the supply numbers. The future supply numbers depends on what happens with the purchase index and housing trends. The Fed, through our base case forecast, is through the end of the year will continue at $40 billion net per month. So for the next 6 months, we're taking $240 billion net. And we see $107 billion in net issuance for the rest of the year of that 260 billion number. So private investors will have to sell $133 billion, primarily money managers, some banks, some overseas investors through runoff, not actual sales, to keep up with that Fed demand. This creates an enormous technical, it drives roll specialness, as you mentioned, especially in the coupons where the Fed is in 2s and 2.5s. In coupons like 3s, where we've started seeing some weakness, but year to date, the best performer because there's a lot locked out in bank portfolios, and the free float in these coupons is gone to the new prod, essentially pricing these at 0 CPR. On rolls, the 2.5 coupon is trading special, and when we take that specialness of about 5 1/8, when we look at the total carry on that, for a year, if this remains the case for a year, you're looking at an added return from carry of almost 2% or higher, 260 or so, and 240, and that's compelling relative to the treasury yields you're getting in the 5-year, 7-year, 10-year part of the curve, which is all below 75 basis points. So the carry argument keeps the fast money proposition very secure with the Fed outlook baked in. I'll just close with your point about specs. Where rolls go, there go spec payups. We see a strong line in the sand drawn between the Fed coupons and 3s and below, and the fundamentally driven coupons, 3.5s and higher. The 3.5 specs, for instance, have fully retraced the decline that we saw in late March, early April, and year to date are positive in performance, outperforming hedges. 3s are possibly the most vulnerable coupon because that coupon, it's contingent on if the Fed exits that coupon. And secondly, if banks who have locked up look to sell some of that. It's not our baseline view, but those are some of the risks that drive roll specialness as well as spec payups.
It is interesting that despite the strong roll, that spec payups have come back so much. I imagine that has a lot to do with the fast prepaid prints we've been getting the past couple months and the surprises we've seen there. Walt, in terms of the impact of QE4, the impact that's having on the fundamentals of the secondary mortgage market, what do you see as the most striking impact of QE4 on MBS performance? And do you see it as all a positive, or if not, what do you see as the downside of Federal Reserve involvement?
Well, we recently highlighted probably the biggest downside, which is a lot of QSIPs are trading with negative yields right now. If you look at short-term historical prepays, 1 and 3 month CPRs, and even model projected prepays. If you look at the 3 coupon trading in the low 105s, when you start to look at 50, 55, 60 CPR prints on the major pools there, you're getting negative yields. And although the Fed's policy is not to have negative interest rates from a borrowing cost standpoint, we are getting negative interest rates for a fair number of investors out there with certain pools. And so that does create a problem. And then the other thing, too, to keep in mind is all the panelists have been talking about sort of an outlook for faster prepays. We talked about the great dispersion in mortgage rates around the mean. A lot of us are calling for tighter primary secondary spreads. Even so, prepayments are likely to remain elevated and dollar prices are likely to remain high. So that is a downside to it. And Yelena was right. The Fed doesn't really control what happens with the primary secondary spread. But over time, Vipul is also correct that we're going to see that start to move in a little bit, get a little bit tighter. So the outlook for prepayments really isn't in the short term to slow down anytime soon. And the outlook for the Fed isn't to slow down their purchases anytime soon. So this issue of really avoiding the pitfalls in the mortgage market, I think, is a fundamental issue that most investors have to face right now.
Right. Yeah. Yelena, based on your experience, how closely does the Federal Reserve monitor the impact of its MBS purchases on both the primary and secondary market? And in your view, what would cause the Fed to significantly alter its mix of MBS versus Treasury purchases? If it's the decline in primary secondary spreads is slower than expected, but as Walt pointed out, the impact of the secondary market is more than desired. Would you think they'll hold on and just keep purchasing until they get the primary market rate where they want it to be, or?
Okay, so first of all, to answer your first question, is the Fed is clearly monitoring everything that is happening in the financial markets very closely. They always say that. Just give you an example, back at the end of March, when the Fed purchases of MBS created margin calls for some independent mortgage originators, the Fed kind of stepped off the pedal a little bit. At the time, the Dallas Fed President Kaplan noted they're very focused on that. So obviously they're getting a lot of phone calls from business contacts, and they definitely make sure that they spread the word around the system. The question to me is whether they can really do much about or want to do much about fine-tuning these extraordinary measures. Remember that monetary policy, and QE in particular, is a very blunt tool. They can only do as much. So as long as the American consumer is happy and they see a slightly lower mortgage rates, they'll keep on going. And I guess I agree with Satish. They will continue to purchase at 40 billion pace, and that's what we are going to see going forward.
Okay, thank you. Jeff, I think you wanted to review our polling.
Yeah, thanks, Steve. So hopefully you should see the results up on the screen. One thing that I found interesting is, more than the current level of purchases was 17%, current level of purchases 37%, less than the current level 37%, and no additional purchases 9%. So it's roughly almost 50-50 at the current level or more versus somewhat a lower level or not. It's actually 54% for answers A and B versus 46% for less than the current level, and 9% actually no MBS purchases are needed. So again, thank you for that. We're going to move over to section 3, our final section here. This is going to focus on the outlook for MBS and performance measures. Final polling question is as follows. Given the current pricing in the market and your expectations for the path of the pandemic, your own view of the economic recovery, where would you recommend weightings for mortgages relative to the Bloomberg Ag Index? So take a couple seconds, answer that, and Steve, on to the last section.
Great. Thanks, Jeff. So I think we're running a little behind. So on this third section, I'm going to try to keep it a little quicker. And if each of our panelists could sort of give us their answer to the polling question, looking forward over the rest of the year, are you given current prices? Are you overweight, underweight, or neutral on mortgages? And maybe give a sense of what you think are the sectors to be paying the most attention to within agency MBS. So let's start with Vipul. With Brian.
Hi. I'll be very quick. I think we are overweight mortgages versus rates. We are neutral on mortgages versus other spread products. The chaos of last 3 months has been, pretty amazing. The QE started just to stabilize financial markets. I think that in June, the QE was sort of transitioned into to improve financial conditions, as Yelena has said. QE1, QE3, both lasted well over like 1.5 years. The Fed has bought about 800 billion of mortgages on a gross basis, close to that. On a net basis, about 550 billion. I think that it's more than swamping the net supply that we saw and we're going to see. 40 billion a month on a net basis, plus reinvestment of its portfolio. And so if you look at the spreads right now, our main outlook is that we've been dependent on our index spreads, our model spreads. I think the models has been kind of challenged because of the extremely low rates that we're seeing right now. And I still think if you look back in QE1 and QE3, those spreads got to be as tight as 20, 30 basis points lower than we are today. And so I think that's the main reason that we are advocating for overweight versus treasuries. I think the banks will need to buy because they have 1.4, 1.5 trillion of cash and reserves built up over the last 3 months. And at the very least, we think that banks will be a key driver of the demand going forward. And so will the Fed. The Fed is taking away 40 billion on net basis. The mortgage market is still relatively small, compared to the net supply that you're seeing from the corporate bonds, high yield bonds, and those are those are through the roof right now, and so that's why we're overweight. Thank you.
Thanks, Brian. Vipul, how does this align with your view? Are you overweight, underweight, or neutral relative to rates and corporates?
Right. Our views are very similar to what Brian said. We like mortgages here. We prefer conventionals. We are neutral on Ginnie Fannie swaps. So we like conventionals. We like production coupons. We like the coupons that Fed is in. 2s and 2.5s in particular, both 30-year and 15-year. Our view is that not only there is spread tightening potential, but carry is going to be a significant source of total return. We expect rolls to remain very special in those production coupons. Overall, in our view, the environment in mortgage market is very similar to what we saw towards the end of QE3. We expect spreads to tighten back to the levels that we saw at the end of QE3. So as Brian said, another 20, 30 basis point of tightening. As far as corporates and mortgages are concerned, I would say there's clearly more spread tightening potential in corporates right now. But at the same time, I would say there's a lot more economic uncertainty that you have to deal with corporates. I think in corporates, because they have raised so much cash, so at least they don't have much of a liquidity concern, so they can tide that over. But fundamental earnings potential risk is still there. So I would say we kind of neutral between corporates and mortgages here, but within mortgages and treasuries, we really like mortgages. And I would say, as I said, the levels that we got to at end of QE3 is what we are aiming for.
Got it. And Satish, is this in line with your views? So overweight versus treasury, neutral versus other spread product?
We are neutral, the mortgage basis and allocations, though we do have have had a very strong down in coupon, follow the Fed, pocket carry positioning view. The factors that change could start as early as tomorrow when we get the Fed stress test results, because in line with what Brian mentioned, key for us to turn overweight is for a structural bid from domestic banks to emerge. And there are two arguments to be made. One is the earnings argument. Banks will need to generate earnings. And we're looking at bank stocks, particularly relative to S&P, to really sound the all clear, because to us, that would signal the driving factor that's kept banks at bay right now is capital preservation. And so to us, it's a capital preservation when the economy is taking a hit, when their portfolios tend to take a hit. The stress tests will tell us in how opportunistic banks can be. So real money demand, particularly domestic bank demand, is critical because right now it's just the Fed and fast money that's buying. The second is, I agree with Vipul and Brian on credit over convexity. Positioning to us has all been favoring V-shaped recovery, high beta sectors. So I won't belabor on that. I will say since mid-May, when the Citi Economic Surprise Indices and the Bloomberg Economic Surprise Indices started to really surge higher, we started to see mortgages lagging credit. So that's something that we're watching. And then finally, I would see mortgage rates. To the points earlier in the panel, today United Shore lowered their VA purchase and refi rate to 2.25%. That is telling us that capacity is coming back into the system. The points that Walt mentioned on sub 3% rates and no generic rate, but we are beginning to see a progression. And that tells us that we're going to have media effects, we're going to have convexity challenges, and that's what keeps us concerned about everything 3.5 and higher. And so we're keeping a close eye on that. And essentially, I think fundamentals matter a lot more because 2s and 2.5s are a very small share of the index today. We've not had enough production. And so fundamentals really matter a lot more than they did in the past, rather than just blindly following the Fed. We see the market as technically driven and fundamentally challenged and exposed.
Thank you. Thank you. I'm going to have to get that link from you. That sounds like a good rate. So Walt, I know you have strong views about sort of looking at CUSIP level versus cohort level analysis and looking deeper into mortgages rather than sort of as a universe overall. But before you, and I want to hear your views on that. But before we do that, can we get your quick overweight, underweight, neutral, just so we can have our own little panelist survey as well?
Sure. I would be neutral too, and really for a lot of the reasons that Satish mentioned. That we really do see a market in here that it's very difficult when the specter of very poor performance at the CUSIP level can really impact the basis. The Fed is a huge driving force. Yelena's right. They are paying attention. They're trying to kind of balance everything off at the same time. And the question, though, that we have with our investor base and our counterparties is we're just trying to help people avoid the pitfalls within the market. And so to your point about the question, the CUSIP level analysis right now has never been more critical, in my estimation, than in my 2 decades of doing this. It used to be that you could say, well, this coupon is good and this particular cohort is good, and there's still a lot of value to be said about that, particularly in the TBA market, which has already been mentioned. But when you talk about actual buy-sell decisions, when dollar prices are 105, 106, 107, and your prepayment assumption is off by 5 CPR, that could change your yield profile or your yield profile by 30, 40 basis points. You can change your monthly carry profile by a few ticks. And so it really does matter. The CUSIP level does matter very, very much. But I would say that the strong technicals matched with some of the challenging fundamentals with prepayments, I think it all adds up to about neutral.
Thank you. Jeff, I know you received some, that's the end of my questions. I know you received some Q&A from listeners. Did you want to ask any of those?
Sure, Steve. Thanks. First, I'm going to go over the final survey results. Overweight, underweight, neutral mortgages versus the Ag Index. We had 46% of the audience selected overweight, 26% selected underweight, and 27% selected neutral. Looks like they changed just by a hair there, but again, thank you to the audience for your insights. And then if we have time for 2 questions, the first question is going to be for Vipul. You put Vipul up on the screen. I'll just ask the question. And this comes from the audience, what additional steps could the Fed or the FHFA take to promote lower mortgage rates that could eventually help promote more consumer spending to stimulate the economy?
I think at this point, there's not a whole lot for Fed to do. I think 10-year Treasury is already at 70 basis points. At the end of the day, it boils down to capacity. When your pipelines are full and you cannot handle any more volume, it's a very classic Econ 101, you raise the prices. But I think these rates don't stay forever. I mean, we will see a drop in mortgage rate in coming over 2-3 months. We've already seen, like, if you remember, in March and April, mortgage rates were at 3.5% when 10-year was at 70 basis points. They have come down by 40 basis points over the last 2.5 months. And as I said, we expect it to come down by another 35-40 basis points over the next 2-3 months. So I think there's not much to do on that front. But I think on the policy front, I would say FHFA has been phenomenal in terms of the pace at which they have rolled out policies and to really reduce the friction. I would say to us, the biggest surprise was that the COVID-related issues didn't really create much friction. Speeds came right in line with what Refi Index was saying. And to me, I think that's kudos to FHFA to kind of make sure that the credit continues to flow despite all the stresses we have had in the system.
Great. Thank you very much. Great insight. And last question for Satish comes from the audience. How much does the work from home dynamic impact at all large urban areas home pricing in areas like East Coast where we already have high home prices and pretty high taxes?
Yes, I think there definitely is a urban to suburban move. I think that the headlines, the move from potentially rental to purchase as a focus on owning your space and controlling your space, social distancing, just needing more space. I think are factors. They're obviously not factors that we can model. Our home price forecasts in aggregate factor in income. So I think that from a projection and a modeling standpoint, it has, I think the income part of it and the unemployment picture is going to be the primary thrust of what's going to drive home prices. And then the other factors, exogenous factors around transitions from urban to suburban, from rental, which is we've got 40 million households that rent. So even if we get a fraction of them moving into ownership, given what housing stock and supplies, those can be very powerful forces that create some deltas around the home price forecasts.
Mm-hmm. That's great. Thanks, Satish. And thank you all. In closing, I'd just like to thank all the panelists for participating today. I'd like to thank all of our audience members for your time. We know it's precious. So we appreciate any feedback you have on this event. Again, I'd like to try to make this a series of roundtables and different topics. So feel free to reach out to myself or anyone in the mortgage team. And if you have any specific questions for the panelists, reach out to them directly. You can reach out to me and we can facilitate setting up some one-on-ones for each of you. So again, thank you all. Stay healthy and stay safe. And